In the old days, the ultimate portfolio was 60 equity, 40 bonds. You rebalanced every quarter and you go to the beach, and that delivered tremendous returns. That portfolio died with COVID. That the 60/40 died with COVID, and it remains dead because the policy settings have now shifted structurally towards um, far more inflationary policy settings. And in that world, I think you move from 60/40 bonds to equities to something to perhaps 60 equity, 20% precious metals, 20% energy. I tend to believe energy stocks are the new bonds in a world in which bonds no longer work.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. While much of Wall Street's focus over the past recent years has been on the AI hyperscalers, there are an increasing number of seismic developments happening internationally that investors need to be aware of. For example, as a basket, emerging market stocks have outperformed the S&P this year. And to name just a few others, Japanese bond yields have surged to the highest levels in 20 years, threatening to put an end to the carry trade. A US-driven regime change in Venezuela looks imminent. China continues to fire its monetary and fiscal bazookas with gusto in an attempt to pull itself out of its deep balance sheet recession. And in the wake of negotiating a tenuous peace between Israel and Palestine, renewed efforts are underway to bring an end to the Russia-Ukraine war. Which international trends are the most important for investors to be tracking right now? What are the biggest risks, and where lie the biggest opportunities? To better understand the situation from a non-US perspective, we're fortunate to welcome back to the program Louis Gove, founding partner and CEO at GovCall. Louis, it's a pleasure to have you on. Thanks so much for taking the time to join us today.
Thanks for having me on, Adam. I'm glad to be here.
Thanks. Well, it's a pleasure to have you on. And as I just said there in the intro, there is a lot going on internationally. I don't ask this question that much anymore, but given it's been a while since you've been on and your purview really is the international world, I'm going to ask you this general question. What's your current assessment of the global economy and financial markets right now?
So, look, I think if you start off just on where policy lies, right? I think everywhere you care to look, you have very easy fiscal policies. China this year will probably be running a budget deficit of 10% of GDP. This is the second biggest economy in the world, running a budget deficits such as you usually don't see in peacetime. The US, I think, this year will be running budget deficits of around 6% of GDP. You look all across Europe, all the European economies are somewhere between 2 and 4.5. Japan, you have a new prime minister in Japan that's promising to really step on the fiscal gas. So almost every major economy is doing fiscal stimulus at this stage. Then on the other side of that, you have monetary policies that are being, very accommodative. Today, the US, you have twin deficits, so budget deficit and current account deficits. That's probably together going to be in the double-digit territory. You have unemployment rate below 4.5%. And the whole debate is how much the Fed should cut, not how much the Fed should raise. And you've got the ECB that's cutting interest rates. You've got the Bank of Japan that's sitting on its hands. The PBOC that's got its lowest interest rates in history. So everywhere you care to look, you have very easy fiscal, very easy monetary policy. And the end result of this is reflationary trades everywhere are working. You highlighted in your intro that emerging market equities are doing better than developed market equities. Well, emerging market bonds are also doing better than developed market bonds. You have most metals, obviously gold and silver and platinum have been capturing a lot of headlines, but copper as well, breaking out to the upside. Pretty much, financials are outperforming in most major markets. Everywhere you care to look, reflationary trades are working, except perhaps for one reflationary trade, which has sort of languished, which is energy. That's the one reflationary trade that has not ripped higher, and perhaps fortunately so, because as energy prices stay low, this creates a further boon to global growth. You've heard me say this many times, and you and I have discussed this in the past, but economic activity is energy transformed. So
Hmm.
when you have a cheap cost of energy, that really supports growth, especially in emerging markets where growth tends to be more energy intensive. You know, when you're building roads, when you're building buildings, when you're building stuff, it consumes a lot of energy. So when you think of Southeast Asia, when you think of China, when you think of India, when you think of Latin America, the low price of energy is a boon to most economies. Of course, not the guys who do produce energy. So if you're Saudi Arabia, it's not great news. But everybody else, it's pretty great. So today you have low energy prices, super reflationary policies. Perhaps we shouldn't be surprised that things like copper prices are ripping it higher.
All right. And do you see this trend as a trend that will maintain, build steam, or decline as we head through 2026?
So I think that's obviously that's the single most important question. You know, in investing, usually the trend is your friend. So
Hmm.
what could potentially turn this around? Right now, that's the trend. What could interrupt this trend? Um, it seems unlikely that you're going to get a tightening in monetary policy pretty much anywhere. Just as it seems quite unlikely that you're going to get a tightening of fiscal policy anywhere. So, you know, what could disrupt this trend? I think of two things, well, actually three potential things that could disrupt this trend. The one I'm the most worried about is energy prices join the party. You've seen in the past few weeks, so we're taping this in mid-December. If you go back to a month ago, natural gas prices in the US were what, $3, a little bit under $3. They're now above $5. Now, when you look at the past few years, really the past 15 years, natural gas prices in the US have broken above $5 on three different occasions. They broke above $5 in the polar vortex of 2013. They broke above $5 in 2021 when the Texas grid broke down. And they broke above $5 when Russia invaded Ukraine in the winter of 2022. And, today, it feels like energy prices might be grinding higher. Energy stocks are definitely stopped behaving all sickly and weak, and they seem to be joining the party. So that perhaps is your first big threat to the environment for 2026, is that energy prices start to grind higher. So that's your first big threat. I think your second big threat to the environment that we've enjoyed is that the excitement seems to be coming out of all things AI.
Hmm.
And you're starting to see a rollover there in a lot of the AI plays. And let's face it, you've had a lot of excess liquidity poured into this. And it seems like a lot of this capital is going to be destroyed, written off. Like, the investments that were made will not deliver the hoped for returns. So that could be a bit of a deflationary shock to the system coming into 2026. And then I think your third big risk to this very benign environment is that Asian currencies start to rally. When I look around the world at prices that absolutely make no sense, if you take a step back and you say, what's completely out of whack today? The thing that's the most out of whack for me is Asian currencies. Starting with the renminbi, which is just ridiculously cheap. And you see this, to be honest, in China's trade surplus. China's trade surplus today is 100 billion US dollars a month. No country's ever run a trade surplus this big. That's 1.2 trillion a year. It's gargantuan. And it reflects the fact that, China is so dirt cheap today. I tell everyone I meet, if they don't know what to do for holidays, go to China. You get to stay at Ritz-Carlton hotels in Beijing or Shanghai for 100 US a night. It is like China is so dirt cheap. It's absolutely ridiculous. Now, China's cheap. The Korean won is cheap. The Japanese yen is cheap. And because the currencies are so cheap, I think, and have continued to go down against the US dollar, and because in all those countries, interest rates are essentially zero, I think it's encouraged local savers to pour capital outside. So you're a rich Japanese, you're a rich Korean, your currency keeps going down, you're getting no interest rates at home. So what do? You go outside and maybe you buy aggressive growth stocks in the US that keep going up. Maybe you buy gold. I mean, if you're earning 0% interest at home,
Hmm.
might as well buy gold. And so if you look at who's been buying the precious metals in this massive bull market, interestingly, it's not being US investors, it's not being European investors, The buyers of gold in this bull market of the past 3 years have been central banks and have been retail in China, Japan, and Korea.
Yeah.
And again, as long as their currencies go down, that makes sense. You look at the gold price in yen, it's gone parabolic. But if the currencies start to go up, all of a sudden, a lot of the trades that made sense when the currencies were weakening, all of a sudden no longer make sense. So for now, we are in this reflationary environment, three threats to it: Asian currency revaluation, rise in energy prices, and the AI bubble imploding. Now, incidentally, those three things could easily be linked, because what's going to happen is, let's imagine energy prices start going up. Then one way Asian countries could, stomach the higher energy prices is through higher exchange rates. They let their currencies go up, and like this for them, in local currencies, the higher energy prices don't take as much of a bite. And as that happens, as energy prices go up, all of a sudden the whole business model of AI also comes into question. So these things could easily feed into each other in 2026. Again, I'm not saying this is going to happen. I'm trying to answer your question: what could threaten the
Yep.
reflationary scenario we're in?
Okay. All right. So yeah, you're not predicting this necessarily, but you're saying there's
That
potential.
should be that's what should be on your radar.
Yeah, yeah. And there's potential that any one of these could manifest, but because they're interlinked, you could actually almost have a contagion that spreads across
Exactly.
all three. Let me just ask you a couple questions about each of these.
And that's how Murphy Law's right. It works, right? It's like, if like one thing goes bad, then it triggers another thing and another thing. It's
Yeah, it's
Murphy's Law.
exactly what you
That's
don't want to have happen next is what happens
exactly
next.
that's
Yeah.
Murphy's Law.
Um, so on energy prices, you mentioned that oil and gas stocks, which have been, you know, they haven't
Dog
really
with fleas.
participated in the party of the past couple of years. They seem to be maybe slowly starting to pick themselves off the floor here. Um, as an investor, are you allocating capital there, thinking, hey, this might be a secular turn, or are you not? Are you waiting to see more confirmation before, as an investor, you start committing capital to this?
So I have a lot of capital committed to the oil and gas sector, but not because I think that it's made a turn, but for the reasons, to be honest, I've made the same argument for the past 5 years, and that is that in an inflationary environment, bonds no longer diversify your equity risk. And since
Hmm.
2020, we've been in an inflationary environment. And all the policy settings, as we were just discussing, remain inflationary: big budget
Hmm.
deficits, easy monetary policies. And it doesn't mean inflation appears right now, but the risk is that inflation appears. And more often than not, when inflation appears, as we saw in 2022, it's through an energy shock. In 22, Russia invades Ukraine, price of oil goes through the roof, equities and bonds fall together. The only diversification for your portfolio in 2022 was energy. And I still believe this to be the case. So in the old days, the ultimate portfolio was 60 equity, 40 bonds. You rebalanced every quarter and you go to the beach, and that delivered tremendous returns. That portfolio died with COVID. That the 60/40 died with COVID, and it remains dead because the policy settings have now shifted structurally towards um, far more inflationary policy settings. And in that world, I think you move from 60/40 um, 60/40 uh, bonds to equities to something to perhaps 60 equity, 20% precious metals, 20% energy. And and today I would say that your ratio precious metals to energy has gotten so skewed to precious metals. You know, for the first time in well, I was going to say in my lifetime, but it's not exactly true, because in the late 70s, but for the first time in my adult lifetime, 1 ounce of silver buys a barrel of oil.
Yeah, more today,
It,
actually.
yeah, it's fairly aside from the Hunt brother squeeze. This is completely unprecedented. Usually it takes 3 or 4 ounces of silver to buy one barrel of oil. So today I'm inclined to still have my 60 into equities, uh, to have 25% into energy and 15% in precious metals. And it's and to keep going with zero in bonds. Um,
Okay.
so so I look at energy to it's not that I think, oh my God, we're going to make so much money into energy. It's energy is the hedge in your portfolio. It's what is going to reduce the volatility when inflation spikes.
Got it. And I was just about to ask that. So it's really energy as a hedge, although it is a hedge that pays you, right? I mean,
Yes. But in the
these
old days,
companies
bonds paid you.
pardon me?
In the old days, bonds paid you. You know, if you go
Right.
back to the 80s and 90s, you'd make 5%, 6%, 7% on bonds. Today, that's not on offer. But yes, to your point, energy stocks today, I mean, depending what you pick, but you can get some MLPs and like energy is a pretty broad field. You can get some refiners that pay very high dividends. Today when you look at refiners, crack spreads are very high. They're very sticky. Nobody's building new refineries. These guys pay out high dividends. So yeah, I tend to believe energy stocks are the new bonds in a world in which bonds no longer work.
All right. Energy stocks are the new bonds. I'm writing that down here.
They
Um,
have been they have been for the past 5 years. And when you needed them to kick in 22, they did their jobs.
right. So we have some recent validation of this. And again, just contrasting them to precious metals, which is an inflationary hedge, but it doesn't pay you. You're only benefiting there from the nominal
So,
appreciation.
so I'm not even sure. Yes, so precious metals don't pay you. And I'm not even sure, to be honest. We've debated this internally a lot, whether gold, silver, whether it's a genuine inflation hedge or not. I actually believe that gold is a hedge against too low an interest rate rather than um, inflation. Because you've had periods, in the early 80s, inflation was running high and gold was getting crushed. And it was getting crushed because interest rates were moving up.
Right.
And so and look at what's happened in the past few years. Who's been buying gold? It's been the Chinese, the Korean, and the Japanese. Why? Because interest rates are zero over there and inflation is accelerating. And so if you're a rich Japanese, you're like, well, I'm earning zero at the bank. Inflation is 3%. You know what? I'm going to buy gold.
Yeah.
It's the zero interest rates
Yeah.
that is driving that decision.
I probably should have used the term debasement, which some might
Yes.
say is a function of inflation, but it's a little bit different. And so, yeah, it's when you're concerned that, hey, the purchasing power of my currency,
And
I'm
when I'm earning
pessimistic on.
and when I'm earning nothing at the bank, because look, a lot of people are pessimistic on the US dollar, right? It's like everybody's worried about fiscal dominance, everybody's worried. You can read everything you want on, it comes at you every day on social media, the US dollar debasement, et cetera, et cetera. However, Americans are still not buying gold. Like you look at the flows, look at the shares outstanding in the GLD, the biggest gold ETF. Um, it's actually been going down. Like it's come back up in the past 3 months, but 3 years before that, it was going down every day. Like Americans kept selling into the gold rally. There's shares outstanding in the GDX, which is, it's doubled this year, the GDX. So the GDX is the gold mining ETF. Um, that's at a 10-year low, their shares outstanding. So Americans, Europeans, by the way, same story in Europe, the SGLD, which is the biggest gold mining ETF in Europe, et cetera. That's like had a shrinking shares outstanding for the past 5 years. So I genuinely believe that, in Europe, everybody was buying gold when interest rates were at zero. As soon as interest rates started going up, people stopped buying gold. And when people earn an interest rate, it doesn't even need to be that high a real interest rate. Just there's something psychological about it. When they earn an interest rate at the bank, they keep money at the bank. As soon as they stop earning an interest rate at the bank, they're like, oh well, I'll just, you know what, I'm going to buy myself some gold coins.
So let me ask you this, because I agree with pretty much everything you're saying, but we had a pretty long period here in the U.S. of 0% interest rates. And the retail buyer was not rushing out to buy gold then. And you
Yep,
probably remember, Grant Williams, right? And what was it,
of
10 years
course, he's
ago?
a good friend.
So, yeah. And what was it, 10, 12 years ago, he wrote the piece about gold called Nobody Cares.
Yep.
He said, you as a gold bug, you may be interested in gold for all these things, but it doesn't matter because the rest of the world doesn't care. And then to your point, central banks started caring. And then the Asian speculator started caring. The Western speculator hasn't really arrived to the table yet. I think I've interviewed some people in the past recent months who've said, well, they're starting to. You might challenge that. I guess my question to you is do you think we're going to see that third leg of the Western speculator, the Western investor, come into this market, or are they going to pass it by?
I think they will. I think when interest rates come down in Europe and come down in the US, you'll see what you traditionally see, which is money flow back into gold. Um, and
Okay,
you
but
know,
let me
so
just ask
so
this: why didn't it during the ZERP era in the
um,
West?
so it's a good question. No rule in finance is a one for one.
Yeah.
You could say, well, people put money in cryptos. And by the way, uh, you look at the shares outstanding in GLD, when interest rates were at zero, the shares outstanding were moving up. Um, and it's like since 2020, when basically interest rates are to 21, when interest rates start to go up, that the shares outstanding have been coming back down. But it's so I think that was part of it. Look, equities were ripping. There was a lot of exciting stories in equities. So that probably drew in some of the
Yeah.
flows.
Could it
Uh,
also be too that maybe this time, like, whatever it was, 7 years ago, 7 years ago, the Fed was telling we had too little inflation, and it had
yeah,
been so long since we had dealt with inflation, we kind of didn't worry about it. But now maybe we do after living through COVID.
yeah, it could be. Look, I explaining, broad, uh, the flows of retail investors, etc. It's always challenging, right? Anticipating them is challenging. All you can do is say, okay, this is happening, and the trend is going to continue unless something else happens. But, um, why didn't it happen more? I'm I'm not quite sure. I actually think that during that time in Europe, in Europe, in the United States, you actually did see some gold buying. What you weren't seeing is emerging market gold buying, because back then emerging markets were really struggling. India didn't have
Hmm.
much growth, and China didn't have much growth, and you know, we still live in a world where two-thirds of physical gold demand essentially comes out of both China and India. And as those countries, hit the skids, you had a big real estate bust in China, etc. So, again, perhaps I wish I could call it up now, but you look at the shares outstanding in the GLD in the US, and that pretty much tells you what I think the retail's been doing vis-a-vis gold, since that's the easiest way for retail to buy gold, is the GLD ETF. And it was expanding in the first phases of ZERP, of QE, et cetera. It was expanding. Meanwhile, over that period, China was selling, India wasn't buying, et cetera. And now this has shifted. So the problem becomes, what happens if you start slashing interest rates in the US and retail investors in the US want to start buying again? And at the same time, Asian currencies are kept down because, PBOC doesn't want the renminbi to go up.
Hmm.
And so they print a lot of money. And that money ends up going into gold because that's what they've been doing over the past few years. And
Right.
then you're stuck in, like, all of a sudden everybody's buying gold. Um, and it's not obvious who the seller is. Now, I'm not like arguing, oh my God, gold's about to go parabolic, etc. Because I actually think that in 26, China will revalue the renminbi because it's gotten too ridiculous. Um, Otherwise, it's going to start creating political problems for China internationally. There'll be too much of a backlash. And I also tend to believe that other Asian currencies will follow the renminbi higher. So I think that will actually be a headwind for growth coming into next year. So I don't want a headwind for gold
For
coming
gold.
into next year,
Yep.
for gold coming into next year, because you're going to lose I think the Chinese buyer, once the renminbi starts to go up, etc., will say, okay, what do I buy? I probably buy anything with a yield, uh, either corporate debt, REITs, um, anything with a high dividend yield will get bid up. It's so I'm not arguing, oh my God, just put all your money into gold. It's about to go parabolic, etc. I think there's a scenario where it absolutely doesn't in 26. Um, but the the scenario where it does go parabolic is essentially the scenario where Asian central banks refuse for their currencies to go up, and the Fed cuts interest rates aggressively. Then I think gold goes bananas.
Okay. All right. And let me just ask this before we move on to the next one. You talked about the silver to oil ratio right now, where
Yep,
where now an ounce of silver buys more than a
barrel of oil.
barrel of oil, and that's happened very rarely. When you just look at that from a high level, do you think more that silver may be overvalued, or do you think more that oil may be undervalued?
Look, I think you can look at it in one of three ways. The first way is to say, you know what, this is signaling to me that fiat currencies, the people are losing faith with fiat currencies, and
Hmm.
therefore everybody should be in precious metals, etc. So that's the one possible scenario. The other possible scenario, you could say, no, 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 forget that. It's just that oil, we're moving into a world where we're going to need a lot less oil. The energy of the future is electricity. There's many different ways to produce electricity, and oil is going to become obsolete. So that's your,
Right.
your
We've
second
got all these
possible.
nuclear reactors coming online and
We
all
have
this.
nuclear, solar, and
Yeah.
we can actually produce lots of cheap electricity with natural gas. We can produce cheap electricity with coal. Coal is no longer as polluting as it used to be. You can cut that many different ways, but essentially it's you make the point of, okay, oil might be getting obsolete. So that's the second way to interpret this. Uh, Essentially, the first two arguments, whether it's like fiat currencies are getting crushed and or oil is becoming obsolete, is to say it's different this time. So
Right.
looking at the silver oil ratio, you're looking at a time that no longer exists. Or the third possibility is the one that you hint at, and you say, okay, actually, it is not different this time, but the world hasn't changed all that much. And the silver to oil ratio is out of whack. Um, and yes, I think energy in that ratio, oil is probably too cheap. Um, and so I lean towards that, to be very clear.
Yeah.
My inclination is towards that, but I'm not like saying people who argue the first and second argument are idiots, because they might very well be right, and it's what makes a market after all, lots of
Right.
different opinions. Um, I tend to believe that today, and that's why I said, if the portfolio you wanted it 10 years ago was 60 equity, 40 bonds, and if 5 years ago you needed to shift to 60 equities, 20 uh, energy, and 20 precious metals, personally, I've now shifted to 25 energy and 15 precious metals. And I'm probably on my way to 30 energy and 10 precious metals, because I do think people are too negative on energy today.
Okay, great. And what I love about this conversation is corroborating some of the most recent conversations I've had on this channel around oil. So thank you. I love it when different analysts sort of come to similar conclusions, but they're using their own independent processes to do so. So that's great. All right. So that was the first thing you talked about, where you said, okay, what could put a fly in the reflationary trade next year would be an increase in energy prices, which you think is a could happen, right? Not
Yeah.
it's going to, but it's a could. The second was the AI bubble burst, and you referenced some of the recent I'll say cracks that we're seeing in the AI euphoria. I don't think that thing has broken yet.
I
Although
do.
okay, well, great, and I'd love to hear your reasons why.
Uh,
But just price wise, I mean, the S&P is still within a 1% of its all-time highs, right?
yeah.
When we, in my opinion, when we see the crack, we're going to see those hyperscalers really start to drag the market down. But I'd love to hear you comment on it. Let me ask this short question, and I'll let you run. Um, those hyperscalers represent so much market cap, not
Yeah.
just in an absolute value, but in a percentage value of the major indices. I want to say it's like 40% of the S&P, and I don't know
Yeah.
what it is of the NASDAQ, but above 50, right? Just in like 10 stocks. Um, if they were to go through a substantial, let's say dot-com like correction, right, where the world wakes up, I think you were making a similar argument where they're saying, hey, you know what, we were over exuberant here. We priced this all like all the benefits were going to come in tomorrow. The benefits will probably still come, but they might take years, a decade plus to really flesh out. And so we got a discount for that. I don't see how that doesn't whack asset prices by an awful lot because these are so widely owned. And then secondly, I don't see how that doesn't create a strong disinflationary, if not deflationary, impact in the economy because it has become so dependent on the capex spending from the hyperscalers. So I guess react to all of that.
Yeah, there's a lot to unpack. So look, I'll start off. You mentioned you'd start off with the hyperscaler, so I'll start off there as well. And I will say that the bull market, the initial bull market in the hyperscalers, the 2008, 2009 bull market to roughly 2023 was a highly unusual bull market in that it required very little capital spending. The Googles, the Facebooks, the Microsofts, the Apples, they essentially piggybacked off of the infrastructure that was put into place in the previous bull market and then the previous tech bull market of the late 90s, and the fiber that was put in the ground and the
Yeah, you
satellites
had
in
all
the
this
air.
dark fiber that was just laying fallow. Yeah.
Yeah, exactly. So like Netflix could come in and piggyback off that, etc. So for shareholders, this was absolutely amazing. You had a few companies that essentially captured monopoly situations, which is, awesome enough when you get to do that, but also had very little capex to do. So this thing just generated massive amounts of cash. And so, in our mind, that's what we got used to, and that was the big first phase of the bull market. And as it was starting to look like it was, starting to run out of gas a little bit, in comes ChatGPT, and everybody gets super excited. It's like, oh my God, we get to have another round of this. By miracle, it's essentially the same companies that are going to be making all the money. This is amazing. Except, of course, that this time around, it's a different kettle of fish because you have this time around you need to do massive capital spending and absolutely gargantuan levels of capital spending. And so it's the bull market has now shifted. Now, bull markets that depend on capital spending, you and I, and we look like we're from the same generation, we've seen time and again. You get them, the market gets excited, and there's the phase of the market where the companies that get rewarded the most are the ones that spend the most money because they're going to be the ones delivering the fastest growth. So
Yep.
in China, I spent a lot of time in China. I live in Hong Kong and spent a lot of time in our Beijing office. In China, we had a massive bull market on real estate, and a company like China Evergrande, that became the biggest property developer and before it flamed out in all of its glory, for 10 years, the more borrowing it took on to buy more land, the more the share price went up. You had the same thing in the US during the shale boom. Companies like Chesapeake, the more debt they took on to buy more land, the more the market rewarded it. And
Yep.
same story in the 90s boom of Lucent, etc. It's a constant of most bull markets. The bull markets are actually very capital intensive, and in the way up, you reward the guys who blow the most cash. And then for some reason, at some point, for whatever reason, the market stops rewarding the guys who burn through cash. And you saw this. Very clearly in the past few weeks. I think with Oracle, with SoftBank,
Broadcom.
Oracle comes out and says, "Hey, we're going to spend 300 billion building data centers," and the initial market reaction was champagne all around.
Oh, it's gargantuan.
Yeah, it's like the share price, the market cap on this 300 billion capex spending plan, the market cap of Oracle shot up $350 billion. It was, all gravy, happiness, etc. But then the market said, hold on, 300 billion, that's actually a fair amount of cash. Like, where are you going to find it? How are you going to fund it? And immediately the CDS on Oracle went up from 40 basis point to 110 basis points in like a matter of days.
Mhm.
And then the share price of Oracle started to plummet and went down back below where the announcement was made. And really, it's been going down
Right.
every day. It's been going
I
down
just
every
did
day
the
since.
calculations this morning. It's down, I think, almost 45% since it hit the height there.
Yep. And by the way, exact same story with SoftBank. SoftBank comes out and says, "Hey, we're going to give another 20 billion to OpenAI." And since then, the share price of SoftBank has gone down 45%. And so I think this is super important because most of these guys used to get rewarded for spending money, and now they don't. And now the whole business model of OpenAI, of Anthropic, is to raise money and then to spend it. But if now, as an investor, I'm no longer going to be rewarded for giving these guys money and for them to spend it, why would I keep giving them money? Now, you look at an OpenAI, they burn $12-15 billion every quarter. They have a year's worth of cash in the bank. They need to do their IPO in the coming year. Who's going to be the anchor in the IPO? Who's going to want to put in money in this thing that is valued, to come out at 7, 8, 900 billion US dollars, and at best will burn through $1 trillion before it makes any profit, if it ever does.
Hmm.
So, the whole narrative around AI has completely shifted in front of our eyes, and so yeah, I actually think it is over. I think Oracle rang the bell, and uh, this might slowly unwind, etc. But you know the big question. So you've got this on, now you could say, well, who cares about OpenAI? Who cares about Anthropic? What matters is the pick and shovels. What really matters is NVIDIA, etc. And then you get to the second part of the equation, which is that, the NVIDIA had a very enviable monopoly situation where they provided the very high-end chips to people, and it seemed like it was infinite demand. Well, the infinite demand may no longer be there, and the monopoly situation may also no longer be there, as we saw with the Alphabet chips. Alibaba's also coming out with solutions in the first quarter. So I think the landscape is shifting very, very rapidly in front of our eyes. And things that went up in value tremendously. Nvidia went from 300 billion in market cap in this time in 2022 to 3 years later, a 5.5 trillion market cap. These things can unravel really pretty rapidly. And so, yeah, I do think we've seen the top. Now, that brings us to your next question. Okay, let's assume that you and I agree that this is now running out of juice, that the marginal dollar may no longer be going to fund more capex in AI, whose future return is extremely, extremely dubious. Let's assume that you and I agree on all of this. Does that leave you with a deflationary or inflationary environment? Now, the deflationary argument is, look, there's going to be massive destruction of capital. The U.S. stock market went from 40 trillion in market cap to 70 trillion in market cap in 3 years. Most of that driven by the excitement around AI. A lot of that drove high-end consumption. It probably drove the K-shaped economy that everybody talks about. If you're dependent on a paycheck, you're not doing well. If you're dependent on asset prices, you've done fine and you keep having a good time. So you can totally see how the upper leg of the K-shaped, if you get a bear market in equity, that suffers. And that is true for the United States. But then you'd think, okay, what's going to be the policy response to this? The policy response will be interest rates at zero, because by then Trump will be controlling the Fed. It will be a much easier fiscal policy in the U.S. because it's not like Trump is a fiscal hawk by any stretch. He'll go out and spend a lot of money, and so you'll end up, the end result of all of this will be a weaker dollar. So because of the easier monetary, the easier fiscal, etc. So you'll end up with your weaker dollar, and while you could say, okay, this is going to be deflationary for the US. A weaker dollar, lower interest rates, et cetera, will be very reflationary for the rest of the world. And so you could have essentially the mirror of what you've had in the past few years, where, for the past years, everybody's like, oh, US is exceptional, and everywhere else in the world is either uninvestable like China or boring like Europe and Japan, et cetera. In a world in which the US dollar starts to go down more structurally, then that whole perception starts to shift. And so the bottom line is, this could actually turn out to be quite reflationary for the whole world.
Okay, let me dig into that for just a minute. So presumably there's going to be some time between the wheels really coming off the AI trade in the markets and the policy response, right? I mean, I think the policy response gets faster and faster every cycle, but we're probably going to have to experience a certain amount of pain for the policymakers to really let the floodgates of stimulus, or the rescue floodgates, turn them on. Do
Do
you
you
agree
think
with that or
Trump?
not?
I don't. I don't actually. I don't think Trump has any interest in taking any kind of pain ever. Um, and I think he's already putting all sorts of pressure on the Fed to cut interest rates. Um, the writing is on the wall in terms of cutting interest rates. That's where we're heading. Um, and if the stock market starts to go down, that will happen very, very, very quickly. Um, and
Okay.
so and so
So
will
it's,
the spending of the money. Look, he's already talking again. You have a twin deficits of anywhere from 10.5 to 11.5% of GDP right now, and Trump is talking about sending $2,000 checks to everyone.
yeah.
I mean, it's the so if you get a hint of a recession, you like once you accept the principle of we send $2,000 check, we'll make it three, we'll make it four, we'll make it five, just checks all around.
Okay. Um, at some point, I want to get somebody from the administration to come on here and be able to answer some of these, respond to some of
Do
these
do
assumptions.
you think what I'm saying is stupid? I
I
mean,
don't think what
can't
you're
you?
saying. No, I don't think what you're saying is stupid at all. And trying to channel. Part of me can say absolutely, Louis. Like you're yes, and then part of me can say, well, the administration would say a couple things. One, I think they would say, hey, look, we're bringing down the deficit, and I believe I just saw some stats. I can't remember exactly, but I believe the deficit is shrinking a little bit, right? And then we've got the tariff revenues coming in, and we're going to get the tailwinds of the deregulation and the tax relief. Besant has said that we're going to have probably record tax
Adam,
rebates this
Adam,
year.
Adam, I'm sorry to interrupt, but you're 5 years into an economic expansion. You're 5 years into an economic expansion with an unemployment rate of roughly 4%. You shouldn't have a deficit. You,
Oh, I'm right there with you. Look, I'm not trying to portray either the current administration or even just the current American political scene as fiscally responsible in any way. Um, yeah, no, no. I mean, look, I have been railing forever about this, but I think they would be saying two things, which you could agree or disagree with, which is that, hey, we've got, relief coming that we want that we're going to depend on to help out here before we go back to just, stimulating like crazy. Um, and then secondly, too, and this is going to get me in trouble. Um, this administration campaign-wise, and even still to a certain extent, does some lip service of like, look, it's Main Street's time, it's not Wall Street's time. And I personally, I think the main thing that they care about and why they're pushing the Fed so hard for lower interest rates is less to prop up the stock market, even though Trump loves to point to it, and that's a scorecard he uses. And it's more to make the refinancing of the debt more manageable. And I know they would love to refinance it at longer durations, but at a minimum, they'll happily refinance at the short end of the curve if they can get those interest rates down, right? So to me, I can totally see what you're saying happening. I just am not 100% confident that they would leap right to the same crazy playbook that we've had before. I think they'll pull it out absolutely if the pain gets big enough. I just don't know if they're going to pull it out on day one. Now, probably more than half the viewers here might disagree with me. We'll see.
yeah, look,
Okay.
we'll
Well,
see if
let me
when it
let me
happens.
let me get to the question I was getting to, and then you can answer in
Yeah,
any way you like. You said that you're now 60, 20, 20, right? 60% stocks or 25, sorry,
uh,
25% energy, 15% precious metals. Given your what seems to me level of relatively high confidence that the AI bubble is bursting right now, does that make you worried about your 60%? In other words, are you planning on reducing equity exposure because you expect some of these, knock-on effects in the markets as we talked about? Or are you just pushing that 60% further into the rest of the world because you think that reflation trade is going to benefit from the cascade
I
of
own
steps we've just been talking about?
I own very little in the US. Pretty much the only thing I own in the US is within my 25 of energy. Um,
Okay.
I think the opportunity set else is elsewhere. Look, I look at markets through a pretty simple grid of fundamentals, then valuations, momentum, and investor positioning. And today, when I look at the U.S., you could say the fundamentals are terrific. The U.S. has pocket aces. It's a great story. You got some of the best entrepreneurs in the world, some of definitely the deepest capital markets, et cetera, et cetera, et cetera. So on a fundamentals basis, um, now of course we can debate fiscal policy. We just have. we
Yeah.
can debate, but fiscal policy is a mess everywhere. I'm French, like ours is probably even worse than yours. So it's it really is the question in terms of fiscal policy of the one-eyed man being king. So it's
Right, right. Yeah.
and
There's nobody
nobody
doing it right. We'll put it that way.
there's no stones to be thrown in glass houses and all that. But
Yeah.
so fundamentals, it's that's not too much of a concern actually for the US. The concern, it comes further down the road, is the valuations. By any measure, the US is much more stretched than anybody else.
Yeah.
And so that's your first problem. Your second problem is the momentum. From 2018 to 2024, the US outperformed everyone, absolutely crushed it. But that relative outperformance is now gone. The US is no longer outperforming everyone. And
Right.
then you
As I
get,
said, the emerging market ETF has done
yeah,
better than the S&P this
yeah,
year.
yeah, yeah. Um, and then you get to the investor positioning, and the US today is 70% of the world MSCI. Everybody's massively overweight the US, etc. So it doesn't take, all it would take is a little bit of bad news to all of a sudden people thinking, do I really want to be 70% in the US?
Right.
Or for that matter, good news elsewhere to say, okay, you know what? China is doing better. How come I don't have any? Um, Japan is outperforming. How come I don't have any? All these kinds of things. So today, I just think I look at a market like China. I actually think the fundamentals on China are much better than what you read in the Western press. What you've seen in the past few years is China leapfrog the West in industry after industry. You've got an economy today that has the cheapest cost of capital, cheapest cost of labor, cheapest cost of electricity, and where the government is actively trying to promote stock ownership and trying to push up stock prices. So like fundamentals looks great. Valuations are still attractive. The momentum, China's been the best performing market since the government started to intervene in January 2024. And the investor positioning is non-existent because everybody decided a few years back that China was uninvestable. So, to me, that seems like a much better risk reward proposition than the US does today.
Hmm.
By the same token, I think there's number of markets where the risk reward proposition looks much more attractive. I've written a lot in the past year, and I'm like super bullish on most Latin American countries. Each one has their specificities and particular sensitivities. Brazil and Colombia are more impacted by what happens with oil. Chile with copper, and Peru with copper and silver. So everybody's got different stories, and obviously Mexico as a key provider to the US is very tied to the US economy, etc. So each has their own stories, but each one of these stories is actually a pretty good story. So the bottom line is, I think there's great opportunities in lots of markets that you don't need to stay confined to the United States.
Okay.
So to your question, I think there's uncertainty, indeed. Once the AI bubble goes pop, how much will that impact other sectors? Other sectors that are doing well today, American banks are like doing great, and um, other parts of like healthcare stocks in the US in the past 3 months have started to come back alive, etc. So there's parts of the market that are doing well and that don't depend on the AI story. But indeed, the problem is it's the old story, right? When they raid the brothel, they take everybody away, including the piano player, um,
Yeah.
and the doorman. And so I do think that with the AI bubble, the US is a more dangerous market than other markets.
Okay. So that makes total sense to me. And I think, you could even make a compelling case, even separate from the collapse of the hyperscaling bubble, of just, hey, the whole world is crowded into the US trade. At some point, you're going to have some reversion to the mean. Right now, the catalyst for that could be this implosion, potential implosion of the AI bubble. Um, I guess my question for you, Louis, was, there's the old saying that when the US catches the sniffles, the rest of the world, gets a bad cold, right? In other words, would you expect that a bursting of the AI bubble here would take everybody and the piano player down for some period of time, and then you would think, okay, then the capital rotates into saner places like these countries you're talking about, or do you think the rotation happens without the rest of the world catching a bad cold this time?
So look, that didn't happen in 2001. It depends how bad the cold is in the US. But if you go back to the tech bust of 2000, 2001, 2002, 2001, while the US was delivering pretty poor results for investors, you had double-digit returns on market, and in 2002, double-digit returns on markets like Korea, like Taiwan, like India, like Indonesia. So a lot depends on your starting valuation point as well. And and so, I think the whole saying, oh, when U.S. catches a cold, the whole world goes bad, etc., goes back to a day when the U.S. was half of global GDP. Today, the U.S. is a fifth of global GDP, or like 22, 23%. Um, and you have a lot of businesses today around the world for which China is a bigger market now than the United States.
Hmm.
So I, you know, I would say it's different this time, but it's actually not. We've already seen something like this following the U.S. tech bust. If what happened if you go back to the U.S. tech bust? You had the corporate scandals, you had MCI, you had MCI WorldCom, you had Enron. The U.S. stock market did very badly, but U.S. banks kept functioning fine. Global trade got funded, capital spending kept getting funded, and things were fine. And U.S. exports hummed along. Um, in 2008, if you go back to the crisis of 2008, there the whole world caught the U.S. cold because in 2008, um, the U.S. banking system, but U.S. banks went under, and
Hmm.
U.S. banks stopped lending. And so all of a sudden, you're a Korean manufacturer and you're importing stuff, you're importing, I don't know, nickel from Indonesia, and you couldn't get that funded because American banks weren't lending dollars internationally anymore. Uh, and so the whole system just completely shut down. Massive supply chain dislocations as pretty basic trade could no longer get funded for a period of roughly 4, 5, 6 months. Um, and so, if that happens, then yes, it's a disaster. But having said that, lessons were drawn in 2008, and emerging markets are now funding a lot of their trade outside of the US dollar. Uh, China, which is obviously the big example of this, now has more than half of its trade no longer denominated in US dollars. 2008 happened, and China was like, well, we're not doing that again. We're not leaving ourselves dependent on US dollar funding. And so, the world evolves all the time. So again, it depends what kind of crisis there is in the US. But if the crisis is, look, there's going to be, Nvidia is going to go from a 5.5 trillion valuation to a 2 trillion valuation, and as such, people aren't going to pay 20 grand to go watch the Formula One in Miami, or people aren't going to be spending, millions of dollars at Art Basel, um, and that top leg of the K economy is going to really take it in the shorts, and that means that there'll be less spraying of champagne in Saint Tropez and in Saint Bart's. Uh, what does that mean to your Chinese manufacturer? I'm not sure it means very much.
Okay, so the spirit of the question was, given your optimism for these rest of the world markets, um, should people be who are inspired by your outlook here, Louis? Should they be taking positions now, or should
Yes.
they potentially wait for the shock wave of the bursting of the AI bubble that you believe is underway? I hear. So what I'm taking from you is no. This is the time to start building your positions.
Yeah, I think so, to be honest. Look, it's how will the policy respond to the AI bubble? And I think the policy response will be even more reflationary.
Hmm.
I don't think there'll be any option but to sit on your hands, etc. So,
Right. But
and
more
and
reflationary in the U.S. and the rest of the world is less
everywhere.
exposed to the U.S. than it was.
Yeah, but I think, once you get the reflationary policies in the US, then the US dollar starts to go down. And, the main constraint, if you're a policymaker in Chile, in South Korea, in Indonesia, is always your exchange rate with the US dollar. You never want your
Yeah.
exchange rate to collapse. So if the US dollar starts to go down naturally, you as a policymaker, you have a lot more options. So I think you get more reflationary policies out of the US, and that allows everybody to follow suit. So I don't know. I'm the again, I look at the signal from the markets today, the outperformance of financials, the outperformance of copper, the outperformance of all the precious metals. Uh, I want to ride that trend. I want to ride that trend. I don't want to fade it.
Okay. All right. So, Louis, I'm looking, we're coming up on the hour. This has been a great discussion. It's always super enlightening to talk to you. If you don't mind, can we do a quick lightning round before we
Sure,
wrap things up? Okay.
I'll
So,
try. The problem
I,
with me, I'm always long-winded, so I don't know if I can do a lightning
no,
round, but I'll
no,
try my best.
I would call it information rich, and I would call it signal rich versus noise. So it's all great. So I mentioned the intro that Japanese bond yields have been surging. How concerned are you, if at all, that this could put an end to the carry trade, or at
So
least severely
nuts.
impair it?
No, not so much. Like I think for the Japanese to start repatriating their money, you need short rates to go up. I think they've lost faith in their bond market, and so it's people have lost fortunes in JGBs as bond yields have gone from 0 up to 3.5. It's been an absolute bloodbath, um, and there's absolutely look. Uh, Inflation in Japan is above 3. So are you going to get that fired up for very long dated bonds at 3.5? Maybe if very long dated bonds get to 5, you start getting excited and start bringing capital back, but we're not there yet. So, um, for capital to come back to Japan for the end of the yen carry trade to really happen, I think you either need long yields at 5 or short yields at 2. So we're not there yet.
Okay, not there yet, and it sounds like you're not losing sleep that we're going to get there anytime real soon.
Uh, I guess it depends. I think we'll get there one day, but I don't think we're there in the next 6 months.
Okay. All right. Now, from the cheap seats, it seems like in the US, President Trump is taking a Monroe Doctrine 2.0 view of the world, and specifically as it relates to the Southern Hemisphere, the Southern Western Hemisphere. He's looking to try to help regimes that he thinks are well aligned with us. So, like, let's help Argentina, right? And also, let's get rid of some regimes that are kind of thorns in our sides and may unlock some of the ability to really tap the full prosperity of the continent. And as I mentioned in the intro, it looks like some sort of regime change is trying to be engineered right now in Venezuela. Um, what are your general thoughts on that? Is this a long-term good thing to try to, you know, get some of the more problematic players off the chessboard in South America so that we can really bring to light or bring to bear the full potential of that continent, and especially, working in closer connection with the North American countries? Or do you have a different opinion?
Look, I'm not much of a regime change guy, but I think what's happening in Latin America is actually super bullish for Latin America, um,
Yeah.
and and especially for the other countries. Like if you do get regime change, and again, I'm not a big regime change guy, but
Yeah.
if you do get regime change in Venezuela, this is great news for Colombia. It's great news for Peru. All these countries, these Andean countries that have suffered from these far less terrorist group that have been funded by Venezuela for years. Like if these guys stop getting their funding, that's a huge boon. It's a huge advantage. It's great news. Um, Meanwhile, I think the U.S. refocusing on Latin America, which has been obvious since Rubio became Secretary of State. His very first visit, I wrote about it at the time, his very first visit, at a time when you had obviously the Israel-Gaza war going on, at a time when obviously you had Russia-Ukraine. His first visit as Secretary of State was to Latin America. I think that was a very strong signal. He was actually the first U.S. Secretary of State to have his first visit in Latin America for like 100 years or something.
Hmm.
Um, so I think that was a super, super strong signal. And it's something that, came out again in the White House National Strategy Review that just came out and
Yep.
into the Pentagon Spending Review. Essentially, increasingly what Washington, D.C. is saying is, look, we have everything we need in Latin America. There's the commodities we need. If we need cheap labor, we can find it there. Like
Right.
maybe we don't need, as part of Make America Great Again, we don't need to have like ships all over the world. In fact, we can't really have ships all over the world anymore because in an age of drone and hypersonic missiles, these ships are more liabilities than assets. Like they're
Right.
they're 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 too easy to take down now. Um, and
Right.
so Trump keeps talking about folding back onto the Americas protected by the two beautiful oceans, and
Right.
and
And the Golden Dome,
and the Golden Dome. And I think,
Yeah.
to be honest, and I think he's broadly right. And but for Latin America, it's great news because we saw it with Argentina. If the U.S. comes in and essentially backstops you, um, that means that interest rates can collapse all across the region. Now, it started this year. You've seen Brazilian interest rates go from 15% down to 13. I think we're on our way to 10. Um, and as interest rates, and you can make the same arguments for Colombia, for Chile, for Peru, for lots of places, for Mexico. And as interest rates go down 150, 250, 350 basis points, that's a huge tailwind to consumption, to real estate, to asset prices,
The
of course,
development.
to
Yeah.
development, to everything. So the simplest way to play it, if you're not into taking too much risk, you just buy local currency government debt. And by the way, if you own Brazilian bonds this year in real, you're up 40%. If you own Mexican debt, you're up 35. If you own Colombia debt, you're up 30.
Yep. And
Um,
that's a total return, right? It's
yeah, total
your
return.
yield
Yeah, yeah.
plus currency appreciation.
Plus bond appreciation.
Yeah.
But I think we're at the beginning of such a massive bull market. So I remain a super bull on Latin American debt. And again, like when interest rates fall, good things happen all around. It's such a tailwind for asset prices. So I think that policy shift in the United States is one, it's for real. Two, it's gonna last. And and three, it's super bullish LATAM.
Okay. Two last rapid fire questions, and this first one you can make real short. So clear, you're still a China bull. Of your 60%, most of which or it sounds like almost all of it is in the rest of the world versus the US. How much is in China, roughly?
Half of it. I've got a third in China.
Okay. All right. So you're putting your money where your mouth is. Okay. And then the last, uh, let's all cross our fingers and hope that 2026 sees at least a ceasefire, if not an actual durable peace, hammered out between Russia and Ukraine. What global investment impacts, if any, do you think would come out of that?
So look, I obviously want a peace like everybody else. You want the dying to stop, but I actually think a peace could potentially tear Europe apart. In that, the view of Europe is that we would fund this war until there was regime change until there'd be regime change in Moscow. Um, it looks like this war is going to end without regime change in Moscow. And then from there, the question is, how will European countries react to that? And I think within Europe, there's a growing split between countries who are saying, look, we want to do business with Russia again. So if you think Hungary, Slovakia, Germany, Austria, they're kind of like, oh, we want to buy the cheap energy and sell goods to Russia. Thank you very much. And then you have other countries, the Poland, the Baltic countries, the Scandinavian countries, the European Commission itself, and frankly, France, my own country, that are essentially saying, absolutely not. These guys are war criminals and we can't do business with them. And I'm not quite sure how you compromise on this. Like, if you really don't want something and I really want something, and it's sort of black and white. It's I don't know how we compromise. And so I really worry that this is going to essentially tear Europe apart.
Um, I'm going to ask you an unfair question, because I'm not going to give you any time to really get into it. But I promise if you wanted, we can spend a lot of time with it next time. Um, Perhaps in addition to what you just mentioned with what happens with Russia post ceasefire, how much faith do you have, or what probability do you give the EU of remaining intact from here?
I I look I think
10
that
years from now, what odds do you give it from existing in the same format it's in right now?
I think that when you have military defeats, like the World War One saw the end of the Ottoman Empire, the Austrian-Hungarian Empire, the German Empire, and the Russian Empire. Um, when you have military defeats, very often there's deep political consequences. So
Mhm.
I don't know. I don't think NATO or the EU, I think there's decent odds, maybe 50-50, that neither NATO nor the EU survive this war. Um, and it was a sort of marry in haste, repent at leisure type of thing. We went all in on this war, and I think the political consequences of it will be deeply, deeply felt across Europe. You will have the rise to power of anti-EU parties who say, you know what, we get dragged into stupid wars, we get dragged into wars that cost us our fortunes, etc. That this EU has served no purpose. Let's get rid of it. So I think the odds
Yeah.
are higher than 50-50. To answer your question, in the next 10 years, I'm not sure. I don't think the EU survives.
Okay. I have so many questions for you based on
It's
that, but
it's 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 too at this stage, the EU has become too politically toxic. It's become nobody likes it anymore. Whether you're from the left, whether you're from the right, it's European countries are now split. France, my own, is a pretty good example of this, between a far left, a far right, and an extreme center. The extreme center is still very pro-EU, but the far left and the far right are increasingly anti.
anti.
So all it takes is at some point for those guys to unite, and increasingly both the far left and the far right are starting to hate the extreme center more than they hate each other.
Hmm.
So yeah, I do worry. I think I think there's the odds are not zero.
Okay. I appreciate you answering a tough question without me giving you a ton of time to really elaborate. Like I said, if you want to go deeper into this next time, I'd love to, because there's a ton of questions I have for you coming out of this. And your, situation as a European who spends most of his time looking at the world from a non-US lens, I think your insight would be super valuable on this, but we'll follow that next time. Last question for you, Louis. For folks that have really enjoyed this conversation and would like to follow you in your work, perhaps maybe even consider becoming an investor in GovCall, where should they go?
Yeah, look, the best place is our website. So gavekal.com. You can find everything there. That's GAVEKAL.com. I'm on Twitter, and with my name. Um, it's I'll tweet the occasional piece on there. I'll put up, the occasional joke that I find funny, even if others don't. And so yeah, you can follow me on Twitter, but the best thing really is to go to our website.
All right. Well, Louis, as usual, when I edit this, I'll put up the URL to your website and your X handle there on the screen so folks know where to go. Folks will have the links in the description below this video as well. Louis, it's just always such a pleasure. And you
Thanks a
always
bunch,
just
Adam.
leave it all in the field. Thanks so much for doing that again today.
My pleasure. Great to catch up. Thank you very much for having me. Really appreciate it.
All right. Well, now's the time in the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined this week by lead senior partner there, Mike Preston. John Loder is not here today because I think he's dealing with some frozen pipes. You guys are getting some pretty cold weather there in New England. Mike, how you doing?
I'm doing great, Adam. Yeah, and it's getting really cold in the Northeast, but that's nothing that we're not used to up in New England.
Up in
I'm
New
doing
England.
great.
Okay. And I know you spend time in Colombia. I think you may actually be there now. So maybe you've done the smart thing and get away from the cold.
Sometimes I snowbird a little bit here and there. Yeah. So, and
Okay.
right now I'm doing the smart thing. But born and raised in central Massachusetts, certainly know how cold it can get, and there's another couple of months more of it, but nothing that New Englanders aren't used to.
Yeah, yeah. Well, we'll wish John well in fixing his pipes, and we'll go from there. But Mike, thanks so much for joining us today, and great discussion there with Louis. And again, I'm thinking maybe you appreciate it even more so given the fact that you now increasingly have a perspective from being outside of the U.S. Um, Real quick, what were some of your the things that caught your attention the most, and then we'll start talking about what the markets have done over the past week.
Well, thanks, Adam. I really enjoyed the talk with Louis. He always has great insights. You mentioned there something he said at the end, which is Latin America. He's very bullish on Latin America, and since you mentioned it, I'll go right there. He thinks it's a great opportunity. He mentioned something that I didn't realize, to be honest, that debt issued by some Latin American countries are up 25 to 30% this year. I didn't even
I
know
think you
that.
said in the case of Brazil, like 40.
That's crazy. That's crazy. And obviously, most countries in Latin America are investable. You could argue that some, like Venezuela, still are not investable, but anything and everything can change. I mean, imagine if Venezuela was investable again. Imagine if that regime was safe and companies went there and built hotels and that type of thing. It could be a massive boon for not just Venezuela, but all of Latin America. Latin America isn't a position, it is a position in our portfolio, about 5%. We have an ETF that's focused on Latin America, and that includes all of Latin America, from Mexico all the way down to Argentina, Chile.
Which one is
And
that? Is that EWZ?
ILF,
ILF.
ILF, India, Lima, Frank, Foxtrot, I guess. EWZ is Brazil only. But Brazil is a big part of IWF, so is Mexico, Colombia, Chile. Argentina to a lesser extent. We have a 5% position there, and it's done really well. We're very happy with it, and we're long-term bulls. You've got other guests on the program, most notably probably Tavi Costa, that has been long-term bull as well, and we agree with him and their viewpoint there at Crescat. We have a lot in common as well. So, but it's still not being talked about much. Emerging markets in general, we're bullish on. And Louis talked a lot about that. We have emerging market positions, but in addition to that, we have another position in Latin America. So couldn't agree with him more on that point. I guess I'd like to take it from the top, though, and talk about a few other things that I thought were interesting.
Go for it.
Louis said that monetary policy around the world is very accommodative. That is not going to be a big surprise to anyone watching this program. It's been accommodative. It's been accommodated forever, but it is still the elephant in the room. China's basic budget deficit is 10% of GDP. US is 6%, and I guess Europe is 2 to 4%. I'll take his word for it because I don't know those numbers exactly. But I agree that everyone is in the same boat. Everyone's doing the same thing. How long is it going to go on? Your guess is as good as mine. But everywhere you look, it's just completely, stimulus, stimulus, stimulus. That's been the name of the game for nearly 20 years. It'll end when it ends, and it will end. And this fourth turning that we talk about all the time is going to end probably badly in tears because always there's a crisis and a climax of the fourth turning, and that generally is not conducive with, peaches and cream. It generally is a difficult thing. So that's probably how this is going to end, and these countries around the world are probably going to do even more stimulus. My opinion is we'll find out that ultimately it doesn't work. We will see. He does say that the reflation trade right now is working, and we're seeing big moves in gold, silver, and copper. It's true. Copper, we talk a lot about gold and silver on this program, but copper and copper miners are also doing great. We actually added a diversified, more base metals position. That ETF happens to be PICK. We added that in the last couple of weeks. That's doing well. And just bear in mind that when we talk about individual tickers or things, they're not recommendations, and talk to your advisor or talk to us if you want to understand your own situation. He talked about energy lagging. That's interesting because we too saw that energy was lagging, but recently it broke out and started to, based on our system, exhibit positive trend, and we added a position in oil service companies, ticker symbol XES, a few weeks ago as well. It's a relatively small position, only 2.5%, but we'll certainly potentially add to that over time. A correction, it's actually a little higher than that, so don't quote me. It's closer to 4 or 5%. Some of our other positions are a little bit smaller. So what are the risks to the current reflation trade? First one, really, energy prices increase would be a big problem. You can't build things if energy prices increase. But however, he said that's actually a little bit of a benefit as long as energy prices stay down. That benefits growth. We'll see. Second would be AI trade deflates, and he thinks it's happening now. There's a real risk to the AI trade deflating. We're seeing that. I don't know if that's going to persist, but that's what we're seeing a little bit of. And then also Asian currencies, if they rally, could be a negative. So his current, we're getting down to the end of my notes here, but his current allocation is 60% equities, basically all non-US, 25% energy, mostly in the US, or that's where his US exposure is. 15% precious metals and 0% bonds. He doesn't see much reason to be in bonds. We disagree a little bit there. We think that bonds are going to get a bounce here, particularly as the market tops and maybe crashes. We think the long-term high-quality bonds will rally. That's why we have a small position in TLT, which is long-term US bonds. It's about 7.5% in our model right now. It's interesting. He talked about the fact that even though gold mining shares have taken off, we really haven't seen complete retail participation. He pointed out that GDX shares outstanding are at 10-year lows. That was a surprise to me too. I'll take his word for that. But I think that what we're not seeing everyone all in the miners yet. And we're big bulls in the miners. We have been for quite a while. We still have a 10% position there. And he talked a little bit about the carry trade. You asked him about the carry trade unwinding. I think that we agree with him. We're not too worried about that. Sometimes people ask us that question. He put out a couple good points there saying it's not like all that money's going to come back in at 3%, which is where the Japanese bond is, with interest rates, still low on the short side of things there, with inflation at 3% or higher, maybe 5, 6% if bonds get there. He'd start to worry. And I've got to agree with him. It's really not something that we worry too much about either. So I'll stop there and pause. I've got some other comments in general about the market, but those are the high points that I took enough notice to write down.
Okay. So I agree. He said, "Hey, I don't think I'm not losing sleep right now that the carry trade is going to end real soon." I did think it was notable though that he said, "I do think it will end," right? And so it's a matter of time on that one. And one of the questions that I wished I did time to ask him, I'll do it next time, is just kind of a deep dive on what does a post-carry trade world look like, given that's been such a dominant uh, trend for the past couple of decades. But yes, to your point, he's not calling for it to end anytime imminently. Um, yeah, so let me just. He made so many great points, but I'd love to get your deeper thoughts on this one, Mike, where he said energy shares are the new bonds, right? Where he's basically like, look, I could be riding a bond in the US that I think is basically going to be delivering, kind of a negative real return, right? So instead, why don't I take something that kind of acts like a bond, right? A high dividend paying energy stock, that also, that should do quite well if my reflation thesis comes into play. And so I get paid along the way, but I also have this optionality value where the actual price of the security could do quite well for all the reasons that he talked about. Um, what are your thoughts on that? Because he basically has a bondless portfolio now.
Yeah, no, it sounded like he was pretty negative on bonds, and I think we disagree, at least over the short term. I wouldn't buy
Yeah,
bonds
but
here
but your but
today.
your thesis isn't because you love bonds for the next 10 plus years. Your thesis is that things are going to get bad, and the like him, you expect the central authorities to come in and just drive rates down, stimulate like crazy, and then that compressed time frame that'll push bond prices up, correct?
Absolutely. I mean, I can buy TLT just taking a look at the yield. It's in the low fours. TLT is the iShares 20 plus year Treasury bond. That yield is 4.4. You can also buy, if you want to, if you're adventurous, TLTW, which is the same thing, but they sell 1 month out short calls against it over and over. And that yield is pushing 10% annually. Again, none of these are without risk. Bonds have risk, stocks have risk. Louis talked about energy stocks being bond-like. I guess I can buy that argument, but it's hard for me to think about any equities at all like bonds. So, but I mentioned earlier that we have a position in XES, which is I think it's State Street Spiders oil service stocks. That yield is about 1.71, so just under 2% right now. So I love the idea that we're getting paid almost 2%, but I also really love the idea that to us the chart pattern looks very strong. Recently flipped into relative strength positive versus the broad market S&P, and we're buying that really for capital appreciation. But I can totally understand the bond argument, and dividends are very useful and they're a key part of return, but we're really buying based on chart patterns and capital appreciation. So we're just looking at it a little bit different. And absolutely, path is very important. I think that TLT and long bonds will go up as yields come down. We were flirting with 4% on the 10-year a couple weeks ago, and here we are right now at 4.18. So we'll see. I mean, I think that we're probably topping out pretty soon in yields and that TLT will turn higher, but it's something that we're watching very closely. We haven't bet the farm. It's a relatively small position, 7.5%.
Okay. To that point, we've now had what, three rate cuts in the past three Fed meetings, and now whatever the Fed wants to call it. I think markets are calling it QE light, maybe even full QE now. And yet the 10-year hasn't budged. It's still stuck in that range. It hasn't come below four, yeah, it hasn't dropped below 4%. So I'm just curious from your guys there at New Harbor, do you feel it'll start marching down, or do you think it's going to be stuck until something breaks and then it's going to be the rush to safety as the rescue stimulus plan kicks in?
Well, let me share a chart and bear in mind that nobody knows the future, me included, us included.
Yeah.
But
I'm just curious kind of what your guys' default, yes, there are many probabilities, but we think this one is more likely.
here's what I think is likely. And this is a chart that goes back, I guess, to December of 24. It's a 1 year chart. I can show you a longer chart, but let's start here. This is the 10-year yield with the decimal point moved. I don't know why it expresses like this, but it always shows it like this. It's 41.82. That means 4.182% on the 10-year. And over the last month, we saw three attempts at 4% right here in September, right here in October, and right here at the end of November. So nobody really knows, as I said, but a lot of people are probably looking at this and thinking this is an inverse head and shoulders.
Right. Yep.
And it might be, I mean, I might be. Let me put some lines on here. If you were to draw the neckline, it would be right around there at 418, 417. So right now it looks like we've broken an inverse head and shoulders and we're going to go higher. We're watching this closely. I would say that if we go above 4.3 or so, then I'll probably call myself wrong, and that this was an inverse head and shoulders breakout. But to me, we've just been riding in a downtrend, a very soft downtrend, really not breaking the 200-day moving average. And I see a triple bottom here, one, two, three, and I'm just a big believer that triple touches don't normally hold. I was talking a lot about the silver triple top not too long ago, and maybe a year or two before then, talking about the gold triple top. And you might remember I said they don't usually hold, particularly in commodities. This is an interest rate, so it's a little bit different.
Yeah.
So we have here like about a week outside of this range where it looks like, you know what? We're going up. And we might. But to me, I believe that this is probably a fake out. I won't know if I'm right or wrong until we cross, let's say, 4-1. We cross back down through 4-1 on the downside, I'm going to start believing I'm right. And if we cross above 4-3 on the upside, I'm going to start believing I'm wrong. So that's
All
the
right.
best way I can say it short term is we might be wrong.
All right.
Absolutely
Well,
might be
hey,
wrong.
that's an honest answer. And hey, that's why we have you on the channel every week, right? So we can track this stuff in real time. And as you get more confidence, whichever direction it's going in, you can call an audible for folks. All right. So let's switch to another really big statement that Louis made, which was that he believes that the AI bubble has burst. And I kind of gave my reasons why I'm not willing to call that just yet. I'm seeing the same things that he does, and I definitely have concerns about them. But it's just really hard for me to call a burst when we're still within 1% of an all-time high, on the S&P. Um,
Yeah.
so, not asking you to agree or disagree with him, but if you have strong thoughts, feel free to share them. My question for you, Mike, is all right, let's assume he's right. What impact do you expect that to have on the markets in 2026?
If he's right and the AI bubble has burst and will, even more importantly, will continue to burst, because first of all, I don't think we can totally say it burst. There's some names in that sector that are down pretty hard, but the Nasdaq in general is right near a high, so it's hard to say it has burst. But if it continues to burst and stays there, then that's going to be very bad for the stock market, in my opinion. I don't see a stock market. I don't see a positive market environment if AI slash tech has burst.
Okay, let
I,
me just
you know,
interject. The reason why I ask this question is because I don't just see a not positive stock market environment. Like if this truly bursts and say 40%, half of the market valuation that's currently in the hyperscalers vaporizes because that's what happens during bubble burstings. I don't see how that could be almost anything short of catastrophic for these markets. given how much they make up of the major indices and how much these stocks, these, used to be Mag 7, we'll call them the Mag 10 hyperscalers now, are owned in so many different ETFs out there. I mean, there's so many people who own these companies that don't realize it because they're in some boring named ETF that's in some sector that they wouldn't naturally expect to be invested in these stocks. But these are so over distributed that I have a hard time not seeing the carnage as being very widespread. That's my personal
Yep.
opinion, but I'm curious what yours is.
Well, I agree. If there's a real meltdown, the market is going not only not going to go up, it's going to go down hard. But I have a hard time deciding exactly which proxy to show you here for AI. But here's an ETF. This is not in our model, but this is a pretty prominent global X robotics AI ETF. We're down from 38 to 36. What is that? Down 8% maybe. It's hard for me to say that the AI trade has is over, or that the AI bubble has burst. There's some individual names that are down more, but I mean, we're still trading above the 50-day moving average here. If I show you the NASDAQ, QQQ, I mean, we're just riding the 50-day moving average. We're down a little bit, but and predicting short term is very, very dangerous. But here we are recording this on December 15th, and you know me, I'm not a long-term bull, but I think that this market ends with some kind of fireworks show, some kind of blow off. That's the only thing that makes sense to me after 25 years of experience watching every little dip being bought along the way and pairing that where I think we are in the fourth turning, the final 5 years of the fourth turning. I think we need a blow off all in moment and then a lot of pain. So I wouldn't call this market rally over yet. I wouldn't say that the AI trade has burst. If it bursts further, no, the market's coming down and I'm wrong that we've already seen the top. But if I show you an S&P chart, it's the same thing. We've got a couple down days, but take a look at like the weekly chart. It's been straight up off the April low. And if I go to the monthly chart, man, it's crazy. Here we are from the beginning of the year. We had that April low. Look at that up hammer on the monthly. I don't think I've ever seen anything like that on a monthly chart. And it's been up every month. These are monthly bars. And even look at last month, November, it was an up hammer. And here we are stalling 2% off the top. But well, I wouldn't say we're done yet. I mean, I wouldn't bet big on it like we said over and over again, but I'd be looking for something like 500 points up, plus 500 points, like in a couple weeks' time.
Yeah.
You get up here 7,000, 7,500. We just go pure vertical. That's going to be the best signal you could ever get that we're close. I don't know that we're going to get that, but if we do get it, that'll be kind of lucky because it's going to say, you know what, we're entering the end game.
Yeah. Okay. And I should note too, right before we hopped on to record this, Mike, I saw that the fear greed index was back on fear. And
How can that be?
we are literally 1% below all-time highs. I mean, how bananas is there, right? We have this super bipolar market now that it's either everything is awesome and we're going to the moon, or, this is the end, right? Which is a sign of a very fragile market, to steal a phrase from Lance Roberts. That was the title of this past weekend's market recap video. Do me a favor, Mike, just pull that S&P chart back up real fast. I
All right.
just want to put you on the spot and ask you a question about it. Um,
Okay. Just bringing it back up because I've got one or two others to mention quickly.
okay.
Here's the S&P on a weekly basis.
Okay. Do me a favor, go back to the monthly because it broadens out a little bit more.
Okay.
Okay. If the AI bubble pops, and let's assume Louis is right, and it's just popped right now, right? And so the question is how low? What's a number that wouldn't shock you for the S&P to get down to?
In the next year to two, below this line here, 3,200,
Okay, so below
down into the
3,200.
twos. I think that we could test the COVID lows. Yeah, absolutely. I think we could lose two-thirds from the top. Two-thirds down right now would be somewhere in the twos.
Okay, so I think a ton of people can't even imagine that right now. But that is obviously a very big decline. Not, again, not unprecedented. Certainly we've seen market declines of that amount, and certainly we've seen declines of that or more following, big bubble bursts. Mike, what would that world look like?
That's a world where reinflation doesn't work anymore. All this stuff that the central banks are doing, they try to do it some more and it continues to fail. I think that we would probably capitulate and well, a whole bunch of bad things could happen. I mean, wars could break out. There could be excuses for doing that type of thing. or we're going to have to just realize that the standard of living, particularly in the United States, is going down. We're going to finally have to succumb and adjust our standard of living. That's going to cause a lot of hatred and anger in the US, where the super rich are still going to be super rich if they lose half their wealth, which they probably won't lose half their wealth if the stock market goes down by half. But they will they'll do well even with the S&P down here. The average person will see their 401ks implode because they're not going to trade out on the way down. They've been taught that to buy the dip and only buy the dip, never
Right.
sell.
And
So,
that's if they have a 401k, and then, they may see their job vaporize, right? I mean, you would have to see a lot of layoffs with
oh,
this
absolutely. So
destruction,
the
right?
standard of living goes down by 30% across the board, if I just had to guess, for the rest of our lives, you know? And is that a bad thing? Not necessarily. I mean, maybe there will be some good that comes out of that. We'll be more grateful, et cetera. But the problem is it's a recipe for conflict and surprises, and those surprises are generally bad. And if there's a conflict, it's usually a maximum effort type conflicts in a fourth turning. So it's tough. Standard of living goes down relatively permanently, and we have to live with that. That's not the end of the world, you know. Like we said earlier, maybe other places like emerging Asia or South America, maybe it's their turn to have 50 years of a better standard of living. But it's not going to be we can keep kicking the can. It's the end of kick the can, bottom line. And so wherever this S&P tops out, and my guess is it's up above here, above 7,500 or something, we lose two-thirds. And big bear markets in history go through three major phases. You lose a third, you go sideways. You lose another third, you go sideways. You lose a third. Three one-thirds get you down 66%. That's how the math works. And it's probably going to look something like that with each pause and after those thirds probably is going that pause is going to be caused by central bank intervention, that type of thing. So, but ultimately there'll be opportunities. There'll be opportunities to trade options, to sell premium, to buy support zones, etc. But I don't think it's going to be an L-shaped move that bounces right back like a V. It's going to be down and then sideways for years. So that's what I think. And so what has me convinced that a top is not in yet? I'd like to just get this out there quick. If you take
Sure.
a look at the Russell 2000 on, I don't know, a weekly chart, boom, we just hit new all-time highs on the Russell 2000 last week. We're on a little bit of a pullback. Take a look at the S&P 500 equal weight, RSP. Finally, new highs, little pullback.
Okay.
So we're seeing a
Meaning that the
broad.
market's starting to broaden out.
Exactly. So we can cry, well, geez, the AI trades collapsed, which it really hasn't. If you look at the evidence or the market's collapsing, which it isn't, it's down 2-3%. And the fear index is up there, like you said, has me believing that maybe the energy is building for one final push. And we're starting to see a broadening in the market. That doesn't mean go crazy. We're still at 45% equities. We're not trading from that viewpoint that we have to get every bit of that. But if it happens, I think it's going to be a gift because we will actually be able to reduce equity into that ramp. And we won't be perfect and we'll be too early, but we'll be saying it here on this program if that happens that, this is probably a really good signal that we're close.
Okay. I really appreciate you sharing that. All right. Just to Mike's, I mean, dark projections about what could happen if indeed this is the height of the market and the AI bubble burst and all that stuff. Hard for me to disagree with what a lot of you said there, but I just want to underscore, in addition to the concerns and the risks, there is opportunity here, as Mike said. And of course, the difference is, are you paying attention or aren't you? And one of the things that a lot of the advisors on this channel, the analysts and advisors who have appeared on this channel recently have said, hey, the playbook that has worked so well the past 20 years of passive investing, just buy and hold and ride everything, probably not going to likely work in the future or work well in the future, especially if we're going into a market correction of the type that Mike sees, or just sort of this lost decade that folks like Jam Carson see ahead of here. And even though the trend may be down, to get from the heights now to whatever the bear market low is, there will be vicious rallies. There will be big down years, but probably big up years. The whole point is an active portfolio management strategy very well may be the way to not just survive what's coming through here, but prosper through it. But you've got to be paying attention, and you're probably going to have to go back to a lot of old-fashioned investing practices like fundamental analysis and things like that. You can't just buy the sector. You're going to have to try to find the good players in the sector, all that type of stuff. And obviously, if you don't want to do all that work yourself, then find an advisor who has that expertise and mindset as well. All right. So, Mike, just in wrapping up here, because we're getting late on the time, an asset that is continuing to do quite well, or asset class, is the precious metals and silver itself. And I can't remember if I was talking with you last week, but last week on one of these live recordings I was doing, silver futures cracked above 65 bucks an ounce, which honestly, Mike, I know you thought silver was going to have a good year this year. I don't think you had 65 bucks an ounce silver on your bingo card, as optimistic as you were. Silver then got whacked, had a pretty violent correction down to 61 something, I think. But now we're back up we're 64 something at the moment we're recording here. So, what are your thoughts on silver's resilience here?
It's been pretty breathtaking, Adam, and you're right. This has surpassed even what I thought. I mean, I'll share with you my thoughts right now. Let me first bring up a chart of the ETF SLV. So this is a little bit less than the spot price because the spot price is up in the 64, something like that, 65. But here's a daily chart. And you probably remember this line back here that we were talking about week after week. If I go to the weekly chart, I was saying triple top, triple top, triple top, and
Yeah,
silver 35 right there. That's when we added it to our portfolio. Man, I never thought we would go like this, Adam. Look at all the triangles that we've traced out. Triangle, vertical. This is like, what was that? 14 weeks straight up? And then that was up to that was the first time we touched 50. Then we came down to 40. And we came out of this triangle and just shot straight up. It's been breathtaking, and now go back to the daily chart. We had a big day. Look at that day on Friday, a big red bar. A lot of people, I think, thought, well, geez, that's it. It's over. And here we have a little inside bar day, just basically biding time, building energy for the next move. I don't know what's going to happen next. I can tell you we're way above the 21 day, which is this, and the 50 day, which is this, but really the sky could be the limit here. And I don't want to get people thinking that, hey, it's easy, just buy in. We've been telling people cautiously buy 5 or 10%, and let it go. If you have too much, like a lot of our clients do, if you have 50% or more in your portfolio, which believe it or not, some people do, now's the time to be selling a little on the way up. You're never going to call the top, but sell a little bit on the way up. So we are at 64. And now I'm thinking we're going to go to 70, 75 in the next few months. I don't know, maybe the next 6 months. The truth is, this is a different regime, and you can now buy a barrel of oil with 1 ounce of silver.
yeah,
Louis just said. I
more
didn't
than
even think of that. Either you
yeah.
said it or Louis said it, or you're both talking about
Yeah,
it.
Louis said it, and I just clarified by saying that actually an ounce of silver is worth more than a barrel now. So yeah,
It's pretty amazing. So how far can that go? I think it can go a lot farther. I'd still be very careful. Let's take a look at a monthly chart here. I guess I'm still sharing. Here's a monthly chart. Look at this 2011. Back in 2011, we hit a high and then came down and did not go back. Here we have 7 months straight up. This is different than 2011. So I know you have to inflation adjust, so I'm not sure if we're at a new high inflation adjusted, but we're getting close. This is the biggest triple top I've ever seen, really, in the silver market. The Hunt Brothers 1980, this 2011 top, and now in nominal terms. It's huge. And so, what are the miners doing? The miners, if I just go to, I don't know, GDX, let's go to SIL ETF, take a look at what the miners are doing, even on a short-term basis. We had this downtrend and we broke out. And here we built another cup and handle. I think we talked about this in the previous week. Here's the handle. Boom, we're out of the handle. And here we are going sideways. And I think a lot of people are probably expecting this to fail. The hardest thing to do, Adam, is to hold on to a bullish asset. I mean, I've learned that in my career. It'll try to kick you out over and over and over again. That's not a reason to never sell. Always look at your own risk tolerance and your own exposure. But SILJ, nice little cup and handle breakout. Same
yeah.
thing with GDXJ,
Hey,
same
one thing I
exact
just want to
thing.
note as you're doing that is folks, you can see here that the silver miners, they have yet to have, or they have not had that super, you know, shoot the moon recent history so the silver price has had. They've certainly done well this year. The miners are up about on average about 100% this year, Mike. I mean, just this the general GDX major.
Let's go to GDX here.
Yeah,
GDX start of the year at 33, and here it is at 84. So it's 2.5x. It's going to be 3x soon,
yeah,
just year to date.
just unbelievable. Yeah, but in recent performance has not been as strong as silver's, and a number of people, including Jesse Colombo, have been saying that the torch is likely now getting passed from the metals to the miners, meaning the metals have been outperforming in the near term. Now the miners are going to start outperforming again. And if you want to read a detailed analysis as to why that's likely to happen, you can go to Thoughtful Money's Substack. And the latest macro pass was from Jesse Colombo on exactly that. So just wanted
Okay,
to
well,
point.
I've got a couple of charts here that I can show quickly too, just switching to slideshow mode. This is gold to silver. Just two charts that I pulled together. You might remember talking in the last year or two, Adam. There was a time that we were saying on here, you know what, the gold silver ratio is back to 100. Look at that. Back in I guess
April.
April. We were at 100, 102, 104. We're now at 69. The long-term average is 50-ish, I'd say. Some people might disagree with me on that. This is only 1 year, but the long-term average is around 50-ish. So this could easily keep going. But, we're down to 69, so probably the easy money has been made, but I believe there's more room. And the next chart basically just shows XAU to gold. This chart does go all the way back to 1985. XAU is the Philadelphia, I guess it is. I think it's the Philly index for the gold miners. The point is that it's a gold miners index to gold. And you can see that right around the GFC, they just fell out of bed and stayed there. And we were bulls, and we probably bought too soon. I'm sure we bought too soon, watching this erode. There was a lot of bad decisions made by management in the gold mining space back then. We had all this underperformance, but it's bottomed. The real key is it's bottomed right here at around 20 to 1, or if you flip it 0.05 to 1. And we bottomed there at 0.05, and we're up at around 0.08, 0.09. We've almost doubled, but it could double again from there and still not be excessive. And I know I've said this before, and I guess I'll say it again. If you take a look at some of these things over the long term, just take a look at, I don't know, silver miners, SIL. Let's look at it for a long term. Well, big bull markets will often double off of a base and then double again. So here's SIL on a monthly chart, big bull breakout. Let's call that breakout right around, oh, I don't know, 40. So we broke out and went from 40 to 80. There's your first double. Don't be surprised if this consolidates and then doubles again to
Right.
160 sometime in the next year or two. But it's really hard to hold on to because of all the reasons we just talked about. It's lagging metal or pulled back, or there's a piece of bad news or whatever. But if you've got your position and it's not too big, try to hold on. That's my message.
All right. Well, we got to start wrapping up here, Mike. Real quick, though, just on silver again. Folks, I think definitely listen hard to Mike's advice that if you have a silver position that's done really well and now it's really grown as a percentage of your portfolio, probably wise to think about trimming that back, your traditional position resizing. Don't sell out of your core position, but take some of these paper gains and make them actual gains just in case this turns out to be the top, right? At least you captured some of the gain you had. Um, but if you are continuing to be really bullish silver, and or you're watching this and say, gosh, I wish I had built a silver position. I don't have any. And you'd like to at least start building, a foundational position. I just want to remind everybody, in case you haven't already heard it, Andy Schechtman, who runs Miles Franklin, which is the precious metals endorsed solutions provider for Thoughtful Money. While supplies last, he is offering a special exclusive promotional deal just to the Thoughtful Money audience, which is the ability to buy junk silver from him for $1 under spot price. So this is a relatively rare deal. And if you want to look into that and take advantage of it, or just talk to Andy and his team about any of your other precious metals questions or needs, just go to thoughtfulmoney.com/buygold, fill out the short form there. Only takes you a couple seconds, and then Andy and his team will be in touch with you right away. All right, Mike. Well, look, thanks so much. Things are continuing to get interesting, I think, as we head into 2026. Could be a very interesting year, especially if Louis correct and we witness the true bursting of the AI bubble and all the repercussions that potentially will come along with that, as we talked about here. That could be a very interesting, perhaps very scary year for a lot of people. But anyways, folks, we're going to have Mike and his partner John on this channel week after week, as usual for us in 2026, just keeping us abreast as how things are unfolding. So hopefully there won't be any major surprises, because we'll be keeping you updated all along the way. In terms of Louis' interview, if you enjoyed having him on here, would like to have him back on again early in 2026 to provide an update, please let us know that by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. Obviously, if you'd like to get some professional help or help from a professional financial advisor for how to position your wealth in your portfolio for the coming year, especially if things unfold the way that Louis and Mike think they will, then highly recommend, if you don't already have a good financial advisor advising you, consider talking to one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you'd even like to talk to Mike and his team there at New Harbor Financial. So to set up one of those consultations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. There's no commitments involved. It's just a service these firms offer to be as helpful to as many people as they can. Mike, my friend, as usual, another great week. Thanks so much for being here. Thanks for going solo. And again, please tell John we hope his problems with the pipes clear up soon.
I'm sure they will, and thanks for having me here. I really enjoyed it, Adam, like every week I do, and I really enjoyed listening to Louis as well. And until next week, take it easy.
All right. Great job, Mike. And everybody else, thanks so much for watching.
Obviously, I could adjust my silver up, a bit. I mean, it wouldn't surprise me to see 40, 42, who knows, maybe 50, right? I mean, and I didn't say silver wouldn't, I said just basically don't bet on it. I think silver is bullish at the moment. Gold at the moment, I mean, today, price of gold's down 2%. Will it be up 2% tomorrow? I don't know, maybe. But, we're in a bull market, a long-term bull market for all these reasons, and probably both metals. I'm just less excited about silver, for these reasons. But yeah, I think in both metals. And, for the rest of the year, would it surprise me if we fell short of 3,600 in gold? No, it wouldn't. Would it surprise me if we surpassed 3,600 and we resume the march up and we see 3,800, 3,900? No, it wouldn't surprise me either.
Silver might fall behind gold's momentous rise, but that may leave more room to run when the gray metals rally takes off. With renewed retail interest, sustained industrial demand, and another supply deficit, silver enthusiasts expect prices to reach $40, which aligns with the average expert price forecast for 2025. His benchmark rises to $50 when looking to 2026. Gold regained momentum after losing ground in the days following the announcement of tariffs on April 2, as investors sought safe haven assets. According to the bank's economists, there's a 45% chance of a U.S. recession within the next 12 months. If that happens, the analysts said gold could hit $3,880, $3,800 to $3,900, by the end of the year. Keith Weiner, a U.S. economist and founder-CEO of Monetary Metals, points out that a recent U.S. Customs ruling, suggesting tariffs on 1 kilogram and 100-ounce gold bars, briefly sent gold futures to record highs, disrupting global bullion flows and threatening New York's role as a key price hub. Markets yanked back once the administration clarified that gold would remain tariff-exempt. Weakening global currencies, excessive government debt, and its status as a non-sovereign financial asset continue fueling its safe haven appeal. Analysts expect continued strength, despite temporary pullbacks. Volatility amid tariff uncertainty would be beneficial for gold. Central bank purchases of gold also continue to rise amid a de-dollarization push driven by the administration's tariff policy. Investors have been riding the gold gravy train all year, according to the latest gold demand trends report from the World Gold Council. Gold ETF inflows reached 170 metric tons in the second quarter of 2025, valued at nearly $400 billion, marking the strongest first-half finish since 2020. Silver prices have dropped to their lowest in over 8 weeks. Unlike gold, which thrives as a haven, silver has yet to follow suit with similar gains. Markets increasingly view silver through the lens of industrial performance, especially vulnerable given sluggish factory data and new tariffs, casting a shadow over its near-term outlook. Before we begin, please click the bell icon and subscribe to stay up to date on our latest uploads. We always value your thoughts and feedback.
Yeah, so this is one of those things where, unfortunately, there's a lot of bad takes out there in the gold community. And these bad takes all have the same recipe, which is something happened, and therefore, because something, that's going to cause the price to go up. It always leads to the price to go up. Good news, the price is going to go up. Bad news, the price is going to go up. No news, the price is going to go up. And so we thought that, when Trump took office, there was going to be tariffs on a lot of things, and there was a fear that that was going to include, gold and silver, which would have been really bad. I mean, it would destroy the futures market in the U.S. and force it to go somewhere else. And then we got clarity. No, it doesn't apply to the precious metals. Okay. And it doesn't apply to copper and some other things. Okay, great. Then, I don't remember when that was. Seems like it was a couple of months ago. It does apply to copper after all. So that's really going to kill everybody who manufactures with copper in the U.S. And create some perverse incentives. So, cars don't use that. I'm trying to think of what really uses a lot of copper, but it'll make sense to manufacture that in a low tariff country and import it as a finished good rather than importing the copper and manufacturing in the U.S. So some very perverse incentives there. But we got on Thursday, it came out that some big trader or refiner had asked, I think it was the U.S. Customs Agency for a ruling letter to clarify the status of gold. They wanted legal clarity so that they're not risking not paying something they're supposed to pay. And, obviously they want to make their plans and their investments. Nobody wants to invest money only to be told by the government later, actually, your investment is rendered useless because of this tariff. And the letter came back and said that kilobars and 100 ounce bars are tariffable. They're in the category that's subject to tariffs. Well, that sent the gold market into a tizzy, because apparently that takes effect immediately. Let me talk about kind of the difference of silver versus gold. Silver is much more the working person's precious metal. And when you start to see the jobs market, which wasn't really all that strong for, blue collar, trades. Yes, certain trades at certain times, if you're in the building trades in certain booming cities, I'm sure there was unlimited work. There was a period of I'll call it the unlock whiplash after COVID lockdown was over, where, truckers, had all the work they could handle and more. But overall, the market for, people that are working with their hands or doing a skilled trade, just not been that strong a market. Now, certain niches within white collar knowledge workers like AI, scientists right now are getting these like $100 million packages. It's almost like reading about sports stars. You read about Michael Jordan getting a package like that, and now it's like these AI guys are getting it. But silver is the savings of tradespeople and blue collar workers. And now we're seeing the job market roll over, and that's going to hit, that segment, hard. And in addition, silver has this industrial component. And if manufacturing and all those other things are rolling over because of tariffs, for example, and also because this boom is just really long in the tooth. We're basically in one long boom that was juiced up when in spring, or was it March, April of 2009, the Financial Accounting Standards Board said, you don't have to market the losses. And so the banks were able to restate their financial statements, and suddenly they looked a lot better. And that was pretty much the day that the market turned around and began to boom again. So we're in this hell of a long time, 16 years and counting of boom, which is very long by any historical standards. I think we're well into record territory. So that we could be rolling over just because of that. Tariffs aren't going to help, all kinds of other things. And so silver, because of manufacturing demand falling off a bit and because of working people savers just having less to save, I would generally expect silver to underperform. Now, could silver outperform in the short term? I think there's a lot of forces building up to suggest it could. Because the asset speculative class is seeing silver now. So if they jump into it, almost anything's possible in the short term. But gold, yes, because all the currencies, remain in this horrible bear market, and every government around the world has gone all in on madness, and is getting madder, right? So we elected Trump as a protest against the profligate, stupid spending of the Democrats. And what do we get? A big, beautiful spending bill that accelerates spending even more. And of course, gold responds to that because it's just, it's just a hedge against being a creditor to the government, which is what, if you hold the dollar, you're effectively a creditor to the government. And when the government's becoming something that embarrasses even drunken sailors, you don't want to be a creditor. Well, look around. What asset can you buy that's a financial asset that isn't being a creditor to the government? It's gold. So yeah, we're in this gold bull market. Silver, I think, medium to long term, not really. Maybe it'll keep up with gold at this point. It's not going to outperform. Short term, yes, there could be a big pop in it. That wouldn't surprise me, given everyone can see the chart patterns and say, wow, silver's going to pop. And then they'll make it pop, right? But, is the real long term demand there for it?
Silver's resilience is evident compared to previous years. Since the start of 2024, silver has gained over 50%, demonstrating increasing appeal for investors seeking diversification and growth potential in precious metals. Renewable energy, particularly solar power, continues to fuel demand. Despite some uncertainties for U.S. renewable projects under the current administration, global solar installations are expected to hit new records in 2025, all good news for silver. The solar sector's appetite is so large that by 2050, it could consume nearly all of today's known silver reserves. Geopolitical tensions add complexity. Russia and Mexico, two of the top silver producers, face ongoing political and regulatory challenges that could further restrict supply. Silver's reputation as a safe haven is growing amid economic uncertainty. Volatility stemming from tariff threats and policy shifts since early 2025 has prompted investors to seek tangible assets, such as silver. Interest rate expectations also matter. Even if rate cuts slow, sticky inflation suggests real rates could fall. Silver is set to hit $40 this year and $50 by 2026, according to Peter Croft. The silver stock investor author credits the simultaneous rise in industrial and investment demand, ongoing supply deficits, and positive market metrics for this bold price forecast. Under the right conditions, Croth even thinks silver could explode to $300. Even famed silver investor Eric Sprott shares a similarly ambitious expectation of $250 to $500 silver. Let's redirect our attention towards the interview.
There's a point at which there isn't even necessarily an explanation. Now, the silver people will talk about structural deficits. Now, they've been talking about structural deficits since before I got into this. I sold my company in August of 2008. So we're exactly 1 week away, a week and a day away from the 17th anniversary of that sale, right? That was August 19, 2008. And when I started reading about this stuff in fall of 2008, they were talking about structural deficits for silver. Now, if the price moves, especially sharply in a short period of time, you can't look to a 20-year-old story as the explanation. It's like the left says, oh, consumer prices went up this month because of greed. Wait, are you saying there wasn't any greed last month, and this month greed came into the market and that's why prices went up? Like, if there's something that's basically a constant, greed is a constant, and the alleged structural deficit in silver is a constant as well. It doesn't explain change to the margin. So a lot of people may cite that, but at some point sentiment, takes over and then everybody, wants to buy. Um, yes, it's true in places like India, if gold is perceived to be too expensive, it's also out of reach for, very large numbers of Indians just don't have. Minimum wage in India is between $2 and $5 a day. So it doesn't afford them, much if any gold. Silver is much more affordable. So, if gold becomes less affordable, there'll be some switch to silver at the margin there. That's true. And that can drive it a little bit. Silver is a smaller market. But at the end of the day, I think it's sentiment. The sentiment can be self-fulfilling for some period of time. As it was, I think there was non-sentiment factors as well in 2011, but look at what happened to silver in the first part of 2011. Right, we shot up in late 2010, silver was under $20. And by, was it March? It hit peak or April in 2011, it was $50. So boom, 2.5 times. And then we spent how many years in a bear market in a silver wilderness? So the sentiment, when it turned. It was done. And that first day that silver dropped from $49 to 30, was it 35 or 34? It was like within a day. And all the smart people were like, silver's done, stick a fork in it. It's not going to recover the $50. This is not a market correction. This is wicked volatility. This is a bear market. If you have a loss, take your loss and move on. If you still have a gain, lock it in and move on. This thing is done. And it was for a long, long time. We still haven't recovered. 17 years later, we're getting closer to recovering. Could it go to 50 and beyond? It could. Will we see 30 on the gold-silver ratio again? No way. To see 30 on the gold-silver ratio, we'd have to see over $100 in silver. Keith Weiner, August 11, 2025. You're not seeing $100 on silver anytime soon. Not going to happen. It is what it is.
Although industrial headwinds and uncertainties surrounding tariffs may cause silver to lag behind gold in the near term, its long-term fundamentals remain solid. With projections of $40 in 2025 and $50 in 2026, silver is poised for substantial gains due to its continued industrial application, particularly in solar energy, as well as rising demand and supply constraints for safe havens. In the meantime, gold is still growing thanks to central bank purchases, safe haven flows, and a deteriorating macroeconomic environment. If recession worries materialize, it might reach $3,900. In an unpredictable global economy, both metals remain essential for investors seeking growth and safety. What possible effects might current tariff measures have on the equilibrium between the industrial demand for silver and its attractiveness to investors? If the need for manufacturing and renewable energy around the world recovers more quickly than anticipated, may silver's anticipated surge surpass gold's gains? Leave a comment below with your opinions. Please like this video and subscribe for future updates if you liked it. We appreciate you coming along on this adventure.
If a group of paper gold investors suddenly demands physical delivery, the counterparties will have to buy gold in the spot market since the leased gold is not in their possession. The gold market is liquid, but not liquid enough to support delivery if there were demand for more physical than a small slice of the paper gold market. A full-scale gold panic would quickly emerge. The spot gold price would go to $25,000 per ounce before an investor could yell buy. I take it that someone, possibly Scott Bessent, sat down and potentially explained the paper gold reality to Trump and Musk. Once you understand how the gold market actually works, you quickly back away from putting on a show at Fort Knox.
If paper gold investors suddenly demanded real delivery, the system would collapse fast. Since leased gold isn't actually in their possession, counterparties would be forced to scramble for metal in the spot market, but there isn't nearly enough physical gold available to cover more than a fraction of paper claims. That kind of rush would trigger a panic, with prices shooting toward $25,000 an ounce almost instantly. It's likely someone, maybe Scott Bent, explained this fragile reality to Trump and Musk, which is why they backed away from the idea of making a public spectacle at Fort Knox. Mike Maloney, best-selling author of Guide to Investing in Gold and Silver and founder of goldsilver.com, reveals that China has just issued a groundbreaking mandate requiring its largest insurance companies to allocate 1% of their assets into physical gold. This rule is being funded by reducing U.S. Treasury holdings, accelerating China's shift away from the dollar, and creating massive new demand in the gold market. At current prices, this would consume 15 to 20% of annual global mine production, an amount so large that it virtually guarantees upward pressure on prices. With mine supply stagnant, this structural demand could push gold far above its current record highs in the years ahead. Meanwhile, momentum is building elsewhere. India's pension regulator is considering allowing retirement funds to invest in gold ETFs. Indonesia is weighing limits on gold exports to preserve reserves, and Florida has legalized gold and silver for transactions. Mike Maloney, at the same time, also highlights that Japan's collapsing yen has driven gold to record highs there, tripling in value over the past 5 years. Globally, gold still represents just 0.5% of financial assets compared to a long-term average of 2%. Even a simple return to historical norms would multiply demand several times over, signaling the early stages of a potential gold supercycle. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
Physical gold mandate for insurance companies will reshape the world's gold market. So Avery Goodman, and this is also, this is just a few days old actually. So a couple of weeks. China's insurance regulator now requires major insurers to allocate 1% of their assets to physical gold, creating unprecedented structural demand. This move is explicitly funded by reducing U.S. Treasury holdings, accelerating China's de-dollarization, and shifting global gold market dynamics. The mandated gold buying at current prices will absorb about 15 to 20% of annual global mine supply. 15 to 20% of annual global mine supply, supporting a significant price increase due to limited new supply. Yes, it would. This percentage will get smaller as price goes up. Given stagnant mine output and rising institutional demand, gold prices are likely to rise significantly above current historic highs in the coming years. Absolutely. If this demand that is mandated, that insurance companies do this, right now it's 15 to 20% at these prices. But this is like an impossible situation. The prices have to rise for that 1% of their yuan-denominated assets to be allocated toward gold. Moving on, Eric Jung, Indian pension funds might invest in gold. And this is from Bloomberg. India's pension regulator is considering easing investment restrictions after portfolio managers pushed for new ways to boost returns on a rapidly growing pool of retirement money. It's not money. This is currency, and they're trying to turn it into money, according to people familiar with the matter. Retirement fund managers met senior officials from the Pension Fund Regulatory and Development Authority in a series of meetings late last month and requested permission to invest in gold ETFs. I wish they would just invest in physical gold, the people said, asking not to be named, and so on. The regulators are considering the proposal and have sent the draft language on gold investments to the funds for feedback. So this is something that is potentially happening, and it's big. Moving on, holy smokes, Eric Jung again, Indonesia looking at reducing gold exports to keep the strategic reserve currency within its own borders. This isn't currency. This is strategic reserve money, and it's the only money. They've got a whole bunch of other fiat currencies as reserves, but this is the only money that they hold, but they want to keep it within their own borders. And this, again, is from Bloomberg. So very legitimate stuff. This is old. This was May 27th, but Florida signed a bill into a law allowing people to make transactions using gold and silver. So gold and silver is being remonetized. I mean, nobody's doing it yet. Do you have to make them at face value on the coins of $1 for a silver eagle and $50 for a gold eagle, which is crazy? Or can you make them at the current spot price? That would be awesome. Here's the Ron DeSantis announcing it. Gold just broke 500,000 yen in Japan. The yen is getting torched, and gold is going vertical. Japan's debt to GDP is the worst in the developed world. Their only option, print or collapse. Either way, gold wins, and that is absolutely true. And gold in Japan has tripled since the beginning of this chart. In just the last 5 years, gold has tripled in Japan. You may have heard Rick Rule say that global allocation to gold has dropped to 0.5% in recent years, while the multi-decade average is 2%. Now, I've heard and seen measurements where gold was actually 8% of global financial assets when it was in a bubble in 1980. So a mere reversion to the mean would quadruple investment demand for gold. A reversion to a bubble like 1980 would be 16 times the investment demand. So the price would have to go astronomical. Well, here's the evidence it may be starting. Hong Kong investors triple gold holdings in rush to save haven, according to Hong Kong Shanghai Bank Corporation.
Mike points out that silver remains an extreme bargain at around $40 an ounce when compared to its inflation-adjusted 1980 high of $1,640. At the same time, questions about the accuracy of official inflation data have grown louder. Analysts like John Williams argue that government changes to CPI calculations in the early 1980s distorted the true picture of rising costs, which also explains why long-trusted financial models suddenly stopped working. Gold's steady rise since then, they say, simply confirms this hidden inflation and highlights how far the dollar has fallen since the Federal Reserve was created. Meanwhile, gold market dynamics revealed deeper cracks. The physical gold inventory has been flat or declining even as gold prices make new highs, raising suspicions that major players are quietly pulling gold out of ETFs. On the political front, Trump has floated bold ideas like issuing gold-backed treasury bonds to challenge the Fed's authority and restore confidence in the dollar. Calls to audit America's gold reserves are also resurfacing, as many now frame the issue correctly. It's not so much that gold is skyrocketing, but that the US dollar has been relentlessly devalued and is today worth just 1/3,300th of an ounce of gold. Now let's revise the interview.
Silver, look at where it sits. It is an extreme bargain at just about $40 an ounce because the high in 1980, inflation adjusted, is $1,640. Bam. So moving on, this is, John sent me these recently. This is the Consumer Price Index. This is the original one, the blue line. This is the CPI starting in 1982, where it diverged from the original CPI. And like I said, the truth lies somewhere in the middle. But when I spoke with John, he believes that gold is just corroborating his assumptions because he was an actuary and his models all stopped working after 1982. And he was trying to figure out why something that had worked for years and years and years just suddenly stopped working. And when he investigated it, it was because the government, the Bureau of Labor Statistics, started fiddling with the way that CPI is calculated. And so he also provides, this has some critical dates. The Federal Reserve, Roosevelt abandoning gold, Nixon closing the gold window, and the CPI reporting alterations started right there. And then he also publishes a much longer term chart, taking it all the way back to the U.S. colonies, the American colonies, not the U.S. didn't exist yet. 1665. And you can see what happened because of that green dot, the Federal Reserve. Something evil has transpired. Eric Young again, GLD, gold inventory tonnage versus the gold price ratio at its lows. So this is it, and it just shows I don't trust GLD. The price is going up, the tonnage, is sort of flat. That causes the ratio to go down, meaning that the gold price is making new highs while GLD physical gold inventory is hovering at its intermediate lows. Who is sucking physical gold out of GLD? Thanks, Nick Laird, for the wonderful charts. So gold charts are us, or on X, it's goldfish charts. Moving on, gold revaluation, Trump's red button option. And Trump eyes radical gold idea to expose the Fed and anchor the dollar. And this is about issuing gold-backed U.S. Treasury bonds. Forbes talking about the secret weapon Trump can use to take on the Fed. And he keeps on trying to take on the Fed. The logic of auditing America's gold, the measures reintroduced in Congress, is aimed to restoring confidence in a greenback, the value of which has plummeted below 1/3,300th of an ounce of gold. I'm glad that people are starting to finally state this in the proper terms, that the U.S. dollar has been devalued and is now only worth 1/3,300th of an ounce of gold. It's the dollar falling more than it is gold rising. Now, gold will rise in value during these periods of time when it's basically revaluing it.
In short, gold and silver are no longer just safe haven assets. They're becoming central to a global financial realignment. From China's bold mandates to structural cracks in paper markets, the stage is being set for a historic revaluation of precious metals. With supply constrained and demand surging worldwide, the question isn't if prices will rise, but how fast and how far they'll go. Do you think China's gold mandate could trigger similar moves from other countries or institutions? Is silver, with its extreme undervaluation, the more explosive opportunity compared to gold in this coming cycle? Please share your thoughts in the comments section below. We'd be delighted to hear them. Don't forget to subscribe for more videos and give this one a thumbs up if you found it helpful. We appreciate you sharing in our adventure.
And the price of gold has, it's more than doubled, actually tripled in the last couple of years. So the thing with gold, just in U.S. dollars, going from say $1,500 per ounce to $3,500 per ounce, which was the recent all-time high. What really happened is the dollar has gone down significantly relative to gold. It's a weakening of the dollar. Now, the dollar has performed much better against other currencies. Recently, very recently, last 4 or 5 months, the dollar has gone down, the major indices, but that was from a fairly high level. It actually got quite strong against all the other major currencies, so I expect the dollar to get weaker against other major currencies. But if you're talking about gold, I would expect the opposite, that the price of gold would go up, which means that all the other currencies are falling even faster. So I would expect the Aussie dollar to get stronger relative to the US dollar. I do expect it to go higher. There's no way that gold is going to double or triple, and silver won't be along for the ride. So you can see $100 silver at some point and even higher from there.
Gold has jumped from $1,500 to $3,500 an ounce in just a few years, not because gold changed, but because the US dollar lost value against it. Though the dollar recently strengthened against other currencies, it's expected to weaken further, with all major currencies losing purchasing power even faster. JP Morgan notes that central banks are accelerating de-dollarization, cutting dollar reserves and boosting gold holdings, with the dollar's share of global FX reserves now below 60%, its lowest in 20 years. Meanwhile, silver is likely to follow gold's rise, potentially hitting $100 or more per ounce. Jim Rickards, an American lawyer, economist, and investment banker turned financial commentator, mentions the U.S. is deliberately pursuing a weaker dollar under what's being called a Mar-a-Lago Accord, tying tariffs, trade policy, and even military protection to currency values. Morgan and Reuters highlight expectations of a weaker U.S. dollar ahead. Asset management models suggest the dollar is overvalued by 10 to 20% against currencies like the euro and yen. At the same time, a softer dollar through 2025 is seen supporting emerging markets, attracting investors toward higher-yielding assets outside the U.S. However, Jim Rickards predicts the U.S. will devalue the dollar, but partners must not devalue their currencies in response. As a result, currencies like the Aussie dollar, sterling, and Swiss franc are expected to strengthen because the U.S. is actively forcing it. To ensure you don't miss any updates, don't forget to hit the bell symbol and subscribe as soon as the video starts. If you like the content, please let us know by leaving a comment below.
I would expect the Aussie dollar to get stronger relative to the U.S. dollar, but there's a very specific reason for that. There's a lot of buzz around the world of the BRICS are coming up with an alternative currency, and people are getting out of U.S. Treasuries and losing confidence in the U.S. dollar. U.S. budget deficits are out of control. The U.S. debt is out of control, et cetera. And none of that is basically true. These are talking points, but they have to be put in a context. The U.S. debt, $37 trillion, that's a big number, for sure. But you can't think about debt without comparing it to the resources. What is the GDP behind the debt? What are the assets on the other side of the balance sheet? And those kinds of things the Trump administration is talking about. And so one of the most influential advisors in the White House right now is Stephen Moran. He's an economist, but he wrote a paper last November on basically reconfiguring the entire global trading system. Pretty big claim. In there, he calls for something called the Mar-a-Lago Accord. And by the way, that was the title of Chapter 6 of my book, Aftermath, which came out in 2019, last time I was in Australia. So I'll take credit for coming up with the name. But his version of the Mar-a-Lago Accord looks at tariffs, trade, and exchange rate values, and kind of getting to your question, Jordan, about the Aussie dollar. Now, let's say I put 20% tariff on it. I'm the United States, and I put a 20% tariff on a trading partner. So some goods are, let's just say 100, it could be 100 million or whatever, but 100 as a measure, and I throw a 20% tariff on it. Now it's 120. But what if the trading partner devalues its currency by 15%? So it was at par, let's say hypothetically, and you drop it from 100 to 100 down to 85 to 100. Well, that negates the impact of the tariff, because yes, the tariff marks up the price, but if you're the producer and you can lower your local currency costs, your labor costs and so forth by devaluing your currency, you dilute the impact of the tariff. So what he is saying, and indirectly what the White House is saying to U.S. trading partners, is we're going to put these tariffs on, so that's a given, but don't you dare devalue your currency. Sure. We're going to devalue the dollar. And any trading partner that tries to offset the tariffs by devaluing his currencies, there are going to be consequences to that. And he uses what I call the traffic light system. He says red, yellow, green in the U.S., that's the traffic light. But he said we're going to divide U.S. trading partners into 3 categories. So green, you're a friend, you work with us, we've negotiated the tariffs, you accept the tariffs, and you accept the fact that we're going to devalue the dollar. Yellow, you're okay, you're not an enemy, but you're not our best friend, and you may suffer higher tariffs. Red, you're an adversary, clearly China and Russia. I think it's a mistake with Russia, but China and Russia would be in that category. You're going to get tariffs, if not sanctions, etc. But in addition, this is where it gets tricky. He injects national security considerations. It's like, wait a second, this guy's an economic advisor, maybe a Fed governor, but what's he doing talking about national security? Sounds like Henry Kissinger. But he said, if you're in the green category, you will get the benefit of U.S. military protection. You'll get the nuclear umbrella and more. If you're yellow, we may work with you, and if you're red, you can expect that we'll be in an adversarial position. So the significance of that is he's putting military might and security guarantees behind his claims about the U.S. dollar and exchange rates. Now, that's only been done twice in U.S. history. One was between 1971 and 1974 when Richard Nixon closed the gold window. It suspended the ability of foreign trading partners to redeem dollars for gold. The second time this was done, where the goal was to devalue the dollar, was 1985. James Baker was Secretary of the Treasury. Ronald Reagan was president. But this Baker really took the lead on this. And using some of these indices I mentioned, the dollar was at an all-time high, and Baker said, no, it's not good enough. We have to devalue the dollar. So the dollar dropped about between 15 and 20%, depending on the cross rate at the time. So here's the third instance of the U.S. engineering a devalued dollar. This isn't the markets doing this. This is the U.S. Treasury insisting on it. So I look at the Aussie dollar, sterling, Swiss francs, euro, and say, you're all going to get stronger because the U.S. wants that. The U.S. is forcing that to happen and backing it up with some pretty nice rewards, carrots on the one hand, but a stick if not.
Jim Rickards recalls that since 2010, central banks have shifted from being net sellers to consistent buyers of gold, led by Russia, China, and others steadily accumulating reserves. China, Russia, Turkey, and India have led global central bank gold buying in recent years. China resumed reporting reserve increases in 2022 to 23, adding over 150 tons in early 2023. Russia keeps buying domestic gold while cutting U.S. treasuries. Turkey continues heavy purchases despite economic strains. And India steadily grows reserves while reducing dollar reliance. Eastern European banks like those in Poland, Hungary, and the Czech Republic have also accelerated gold accumulation. Overall, BRICS nations now account for the bulk of central bank demand, far outpacing Western buyers. In addition to this, central banks now hold 36,000 tons of gold, surpassing their treasury holdings in value for the first time since 1996, valued at approximately $4.5 trillion versus $3.5 trillion in treasuries. For the last 3 consecutive years, central banks have purchased over 1,000 metric tons of gold annually, roughly double the pace seen in the preceding decade. A World Gold Council survey shows 76% of central banks plan to increase gold holdings over the next 5 years, while nearly 75% expect to reduce exposure to U.S. dollar assets, a sign of accelerating de-dollarization. Jim believes this central bank buying creates a price floor for gold while leaving unlimited upside, making it a strong long-term play. Now let's delve into the interview.
Well, you're exactly right, Jordan, about the central bank buying, and the turning point, you can actually chart this, was 2010, but right after the global financial crisis of 2008. From 1970 to 2010, central banks and finance ministries, sovereign wealth funds were net sellers of gold every single year. Beginning in 2010, central banks collectively became net buyers of gold. Russia has tripled, more than tripled its gold reserves from about 600 metric tons to almost 3,000 metric tons. I guess it's gone up closer to 5 times. Same thing with China, from about 600 metric tons to 3,000 metric tons. But we've also seen Japan go from 600 to 900 metric tons, etc. Kazakhstan, Vietnam, Philippines, Mexico, Turkey, Iran. Iran's not transparent, but they've been buying gold, etc. So you have this fairly large group of central banks who are buying gold. Where are the sellers going? So between 1970 and 1980, the U.S. sold 1,000 tons. We went from 9,000 metric tons to about 8,100, just a little over 8,000 metric tons. But the U.S. stopped cold. We never sold any gold after 1980. And there are reasons for that. Probably don't have time to go into them. They're highly technical. But so the U.S. has stopped selling gold. We're no longer a seller. We've just stopped at 8,133 metric tons. So the sellers went away. The buyers continued. They will continue going forward. And what's interesting from a gold investor's point of view, central banks and finance ministries are actually very smart buyers. They don't chase the market up. They buy the dips. I had to use cliches, but they buy the dips. They put in just steady orders. They're not out to buy, the whole, everything they need at once. It'll be, 20 tons a month, which Russia did. Central Bank of Russia was very transparent. By the way, just as a quick aside, Elvira Nabiullina is the head of the Central Bank of Russia. In my view, she's the only central banker in the world who actually understands her job. But she put 25% of Russia's reserves in physical gold stored in Russia between 2010 and 2022, which was the beginning of the war in Ukraine. So what did the U.S. do? Well, the U.S. and Europe froze $300 billion worth of U.S. Treasury securities that Russia had bought lawfully. They shipped oil, got dollars, bought Treasury securities, trusted the United States, which was, hindsight, turned out to be a mistake. So there are about 200 billion of Treasury security, Russian-owned Treasury securities in Euroclear. That's all been frozen. And the U.S. does it all the time. We're good at freezing things. But now they're stealing it. They're actually seizing it and using it and the interest on it as collateral for loans to Ukraine so that Ukraine can buy weapons to fight Russia. So Russia's own money is being used to fight Russia via Ukraine. But why hasn't Russia crumbled? Well, the answer is they had $150 billion in gold that the U.S. can't touch, can't freeze, can't seize. And that's one of the nice things about gold. It's not digital. I can't hack it. It's just there. You are there unless you want to invade Russia, which is a whole different thing. And one of the ironies is when the U.S. put all these sanctions on Russia, every sanction you can think of, they've failed. But one of the reasons was they had gold, and Russia has actually made $50 billion in mark-to-market profits on their gold reserves. So on the one hand, here we are stealing their Treasury securities, but by doing so, we're helping to create geopolitical risks, drive up the price of gold. And Russia has at this point, more than $50 billion profit on the gold. So kind of what goes around comes around. Now, here's the thing. From a gold investor's point of view, I like this. This is what is called an asymmetric trade, meaning with a central bank buy, you have a floor. It's not a hard floor. There's no guarantee, but you have a de facto floor under the price of gold, but you have unlimited upside. So you can buy gold with some confidence that it's not going to go down a lot because the central banks will just buy it. At the same time, the sky's the limit in terms of where it might go. So it makes gold a very attractive trade. I should be clear, we are not at the frenzy stage yet. This rally has a long way to go. And the reason is it is a precious metal, exactly as you described, Jordan, but it's also an industrial input. And so the price moves on both vectors. So as a precious metal, I do expect it to go higher. There's no way that gold is going to double or triple, and silver won't, be along for the ride. So you can see $100 silver at some point, and even higher from there. But at the same time, if we're going into a recession, which I expect we are, and manufacturing is declining, and everywhere from China and the U.S. as well, Europe, all over really, then there might be less demand on the industrial side. Although it's demand for electronics is still strong. So you've got sort of two forces. It's going to go up on the precious metals vector, but maybe lag a little bit in terms of the industrial input vector. But on net, I do expect silver to go up.
Do you think central banks' move toward gold signals the beginning of a new monetary order? Could silver outperform gold in the years ahead as industrial demand recovers? If you have any comments, please share them here. In order to receive our latest updates, please subscribe and leave this educational video a review. We appreciate you coming along on this journey.